finally get out and do stuff. And, coming into Las Vegas, I've been here in a long time. And it's like, all this new stuff here. It's like they've got like an impersonator for everybody. It's like and I saw Rod Stewart's coming to town, so I kind of felt bad for the Rod Stewart impersonator because he doesn't have a job yet. It's like, well, once he dies, we'll just change it to Rod Stewart Experience, and then you get to have it. But until then, no, not so much. So let me get my clicker here and we get started. So how many people in this room have no idea what I'm going to talk about today? Raise your hand. Awesome. Awesome. I like to get new people. All right. How many people totally know what I'm going to talk about? Okay. So what we've just done is identified 2 participation groups. All right. Those who know and those who don't know. Right. So the good part is the second group is about to become part of In the Know. Right. So a little bit about myself. So I'm 57. I started on the CBOE when I was 15 years old. And you're like, how do you get a job on the CBOE when you're 15 years old? I'm like, well, when your dad runs Merrill Lynch, it's not that hard. So nepotism's pretty heavy down there. So I started working down there when I was 15 years old. And the first week I was working there, I was in the Texas Instruments Houston oil pit. And Houston Oil had gold in one of their oil wells. The place went nuts. So I'm like, I got a crash course in what fast markets look like down there. So then I came back. I worked summers through high school and college. And then I started full-time in 1989 on the Chicago Stock Exchange. I was a specialist in OTC and listed, which means I was controlling the regional market, as well as an independent trader for myself. So the VROB there, that's a V account is your personal account, and you can see the specialist stuff there and all that kind of fancy stuff. And 270 was my badge number. And here's a picture of me with my friends on the floor. You got JJ up here. Over here, you might have, if anybody who listens to my broadcast, he sits in for me. Well, that's him. That's us. And that's Jim Wynn over there, a buddy of mine. So growing up on the exchange, really, the Chicago Stock Exchange was a bastion of short selling because in those days, we had the interfloor trading system with New York, and they had to have an uptick to short. We did. So we could just hit them. So we just had lines of guys who were short selling. So I really never saw such a bullishness until I went to the props field, and they're like, do you swing trade? And I'm like, I don't even know what that means. Because on the trading floor, it's take a position. So he's got position. And so we would, have lines of these guys just sitting there and just wailing on stuff. And I remember one time with Jimmy, he worked for one of the bigger guys down there, and he's like, Smitty, you want to short this thing? I'm like, why? He's like, because there's going to be an article in Barron's tomorrow. I'm like, how do you know that? He's like, we know the author. And I'm like, I'm in. So a whole lot of fun down there. So this picture is probably 1997 because I'm standing on the floor. In 98, I became a specialist, NASDAQ specialist down there, but I cut my hair in 96. So I'm pretty damn sure it's 97. And there I'm with my son, headband, ponytail, and the screens. So I've been running 8 screens at least since 1990. So I've been looking at a lot of screens. Now I have 16, and we'll get to that in a second. But let's get to it here about what I'm going to talk about here. Everybody likes a good horror story, right? So let me tell you my first horror story. So I'm working on the floor. I'm clerking for a specialist, and I'm going to be getting married, right? I'm not even a member yet. I'm just clerking, but I had an account. And the guy I was working for, big position trader. And, he'd probably make money maybe only 5 days a month, but then he'd make it all. He'd be short and doing whatever, and he'd have order flow because he was a specialist. And so the guy next to us, Harvey Kahn, was the specialist in Compact. Well, this is 1990, right? You know what's going to happen? Eventually, everyone's going to have a computer. This is a big deal, right? Everybody's going to have a personal computer, right? And these guys are on the forefront of it. So Harvey's a specialist, and I'm like, all right, and I'm working for Jim, and I see Compact going 80, 90, 100, 120. And I'm like, yeah, man, I'm in 120. Yeah, let's go. This thing's, everybody's going to have a computer. This thing's going to be awesome. And I come in the next morning, and on the screen, in those days, there was no pre-market, all right? What they would have is an indication where this thing's going to open. And I come in the next morning, and it says CPQ 8090. And I was like, Harvey, what does that mean? He's like, that's the indication. I'm like, it's opening down $30? And he's like, yeah, they had earnings last night. I'm like, Jim? He's like, we'll just buy more. I'm like, yeah, screw them. We'll buy them some more, man. It's cheap, right? Come in the next day, I'm like, 50, 60. It's down another $30. Jim, what are we gonna do here, man? I'm like, I'm almost blown out, and I'm getting married. I barely even started. By the time I blew it out, it was at 36. And fortunately, I had some good capital to start with, but I took a beating. And so Harvey had a computer with charts on it. And he's like, that's Head and Shoulders, that's this or whatever. I'm like, how do you know what that is? And he's like, there's books on it. And I'm like, I walked across the street, I bought every book they had. I was like, I got to figure this. That kind of kills me. And all of them had like an asterisk. Well, nothing works in all markets. I'm like, well, how are you going to tell me what market it is? You know, I'm like, what am I supposed to do? I'm like, so what I did was, for 20 years, I would look at 2,500 to 3,000 charts a day. And I was like, I got to figure this out. And I'm like, there's got to be a commonality here to things that before they move, while they're moving, what they're doing, right? Took me 20 years to figure it out. Took me another 7 to refine it down to what it is, the strat today. But that's how I did it. Just continued immersion of the charts without trying to analyze them at all. I was like, I just got to see them, and something will come to me. So not my first rodeo here, all right? I've been around a while, right? I've seen a lot of stuff. So we'll get to it. So we know almost everybody who sets out to trade loses, right? That's pretty common knowledge, right? It's like when you tell your friends, I'm going to start day trading, do they say, oh, you're going to be rich? They're like, nah, you're going to lose all your money, man. Everybody knows that. So there's got to be a commonality to all this losing, because you have to be insane to start into this business knowing what the attrition rate is, right? It's like, you know, I'm going to sign up for Vietnam. It's like, you know, probably not. And there's so much information out there on how to be profitable. How come everybody's so bad at it, right? There's got to be a reason. There's got to be a commonality, right? So there's a famous study in London from 1848 by a guy named John Snow. And what he did was he took this map. There was a cholera outbreak in London, and they couldn't figure out what's going on. They were quarantining everybody. They thought it was being passed in the air. So he took this map and put it down. He's like, what's the commonality of all these people? Commonality? They're drinking from the same well. It's the water. It's in the water. That's how they figured that out. So what would be the commonality of all traders? Everybody. Pretty much everybody. Right? Technical analysis. It's got to be the problem, right? That's why this was in a used bookstore. That guy's not trading anymore, right? $4, not bad. It has to be the problem because it's the only commonality that everybody uses, right? So if that's true, let's take a look. Okay, relative strength, moving averages, MACD, any of that, it's a momentum indicator. No way. It's not possible, right? They're lagging indicators, all right? So anybody want to volunteer to come up here for a second? Anybody? How about you? All right? Follow me where I'm going, okay? You follow me. Where am I going? You don't know, right? You're following me. That's a lagging indicator, okay? Also, right? So it's also, they talk about a momentum indicator, okay? This is the formula for momentum. Mass times velocity equals momentum. Do you know what price doesn't have? Mass. It's impossible, right? It's impossible for it to have momentum. It's an analogy. It's like it does, just like when you have a sports team. They really got momentum coming into the playoffs. They don't actually have that. It's an analogy. If they did, you wouldn't have to play the game. They have more momentum than that, they win, period, right? Okay. Fibonacci mathematics. This guy has determined the price could go up, down, or sideways. So the problem with Fibonacci mathematics is that mathematics is an exact science, right? 2 plus 2 is 4. 4.1 is F, right? So if that were true, every move ever could be formulated through Fibonacci mathematics. I'm telling you, you probably can't do it once, right? You got decimals in there, right? You probably can't do it once. So, no. Pattern recognition, all right? Here's the problem with pattern recognition. It tells you that the analyst is only using one time frame to fit their narrative. Because we know if it were this simple, well, everybody would just make money. Like, there's a wedge, there's a that, there's a this. We know it's not true. Because also it tells you that they're only looking at one time frame. You want to look at least 4 time frames on anything you're looking at, right? Because I can vaporize that pattern by changing the time frame. Also, software is going to present data to you the way it wants. Do you know that some software updates the 60-minute on the bottom of the hour, others updates it on the top of the hour, and those 2 charts look completely different? You want to analyze data. You want to don't try and read a chart. So let's take a look at this guy.
Weeds here. Over the summer, you basically have this head and shoulders top. Basically, almost. What happens when the head and shoulders doesn't come to fruition, you get a very powerful move in the opposite direction. I think that move's going to take us up.
What the hell? It's like, this is the actually most bearish pattern there is. But when it doesn't work, it's the most bullish pattern in the world. I'm like, you gotta be kidding me, right? You ever known for every pattern there's a corresponding fail to that pattern? You know what that's telling you? It's irrelevant, what you're looking at. The risk-reward ratio. Here's where people really kid themselves. I'm going to buy it at 100, put a stop at 99, and put a sell order at 103. My risk-reward is 3 to 1. No, it isn't. If you had a pie chart of how more likely it is to move $1 than it is to move 3, based on your analysis, it's not even close. Most people have no idea how to gauge their magnitude. And do you know how I know that? You'll have guys say, I think it's going from 40 to 50. And it does, right? And he's going to be the first guy to tell you that. You know, he's also going to say, I'm selling out my last piece at 50. I'm like, you said it was going to 50 and you've been selling? I want to be as long as I've ever been if it goes to 50, right? Well, you didn't know. You didn't know how to gauge his magnitude. He was just talking out his keister, right? The do not trade list. Anybody have a do not trade list? Oh, that stock just has my number. You know, I can't trade that one. I'm going to go trade something else because that one just has my number. If you have a do not trade list, you might as well put them all on there, all right? Price action's uniform, and I know there's different types of liquidity, and I understand that. But when I show you the basics of how price action works, it's all the same. It's just a matter of speed and stuff like that and liquidity. Okay, this is more market psychology, losing psychology. Okay, there's an analogy I like to use about the bus. All right, so most struggling traders will go through charts agonizingly over the weekend and come in Monday mornings like, here's my best ideas, right? Here's my best ideas. I'm like, all right, they just jump right in there. And they get 2 stocks. And one goes up and one goes down. You know what most traders are likely to do in that situation? They're going to sell that winner to pay for that loser and hope it comes back. I want to tell you how insane that is. It's like waiting for the bus, right? You get on the bus and it's taking you where you want to go. And you freak out, you're like, this bus is going to turn around and go the wrong way. And I get off it and get on a bus going the wrong way, hoping that thing's going to turn back around. That's how insane that is, all right? But most people will do that. You want to cut your losers as fast as possible, period. It's not working. And the winners, we want to ride as much as possible and add to them, right? You're right. It's like, why do I want to get out of the one that I'm right in and stay into the one I'm wrong in? It doesn't make any sense at all, but a lot of people do that. So what I do is I invented something called TheStrat, short for the strategy. So we throw out technical analysis and let's go check her out. So from one bar to the next, right, there's only 3 possible things that can happen. Or we call them scenarios. So here, here you'll notice this bar completely in that bar's range, right? Couldn't take out the highs, couldn't take out the lows. That's consolidation, right? Not strong enough to take out either side. That's a scenario 1. Scenario 2, you take out either the high or the low of the previous candle, all right? That's a 2. And most importantly, outside bar 3, you take out both sides. That's all that can possibly happen, okay? And so when going back to pattern recognition, the only pattern that doesn't get vaporized by changing time frames is this, the outside bar. That's a broadening formation on a shorter time frame. It has to be. It took out both sides, right? It's one of the most important things you can know, because once you start failing that too, right, you took out the high. And once you start failing and coming back through here, because we know outside bars exist, we know where it's going. It's going to take out the lows because that phenomenon exists, right? So we want to have more further evidence about that, okay? But we'll get to that in a second, time frame continuity. Here's another thing that's very important. There's only based on 1, 2, and 3, there's only so many ways that price can reverse. So we know what reversals look like. So when somebody says, I'm gonna buy it on a pullback, we say, no, we will trade the reversal. So one of it is this. One of them is this type. 2 down, inside, 2 up. You go down, you have your consolidation, you have your reversal. 2, 1, 2. The New York reversal, 2, 1, 2. The 2, 2 reversal. 2 in one direction, 2 in the opposite direction. And the way you can gauge your magnitude on this is you see that these 2 up, 2 down, right? These 2, like I said, we analyze the data. We don't read the charts. Do we know outside bars exist? We do. So these 2 become an outside bar of that. So we're constantly combining all these things that we know, right? And then we've got the 3 itself as a reversal because it went 2 and reversed back down. Those, if you know those 3 right there, you're good to go. We also have the 3, 1, 2, but we won't get too much into that, where you have the outside bar, then the inside bar. And the reason that's important is the outside bar means they were willing to pay up and sell down. Then you get the inside bar where they met in the middle again, and then somebody takes over. But we're not going to too much today on that. Now, how can we further know what's going on? And when I say 4 time frames, when the higher the volatility, the more likely we are to go down to shorter time frames, because when we have heightened volatility, an hourly bar could be like a week or a month normally. We also use macro charts, which I'm going to get to in a second. And so time frame continuity, here's 4 time frames, right? So with 4 time frames, we say, okay, monthly, weekly, daily, and 60. They're all green. What is that telling me? Remember how we raised hands for participation groups? There's 4 groups out there, monthly, weekly, daily, and 60. At this point, they're taking the offer. They have to be. And when people are saying algorithms are picking me off, no, they're not. They're not. You're getting destroyed by price discovery. In this situation, you have to tell automated trading 4 things, actually 5, how much shares you want to do, but you got to tell 4 things. What do you want it to do? Spy? What do you want it to do, buy or sell? I want it to buy. How do you want it to buy? Do you want it to take the offer, or do you want to sit on the bid? When do you want it to do it? For how long? When this condition exists, I know exactly what they told them. They said spy, they said buy, they said take the offer and do it now. That's what they told them, right? We know that to be true. This has to be true, right? We call that full time frame continuity to the upside. So when we can combine these reversals with that, we'll get a reversal against us, right? Then it lines up with the time frame continuity and another reversal in our direction. Every reason to believe that's going to work, right? And you'll see them turn on and off. So if you go to SPY here, monthly SPY, knowing what I just told you, pandemic, 3, all right? Then in here, 2 down, inside, back up, all right? Did we know about that? We did. You also have that 3, 1, 2 right in here, right? So we knew about that. We also have these months in here. That was an outside month. That was an outside month. That was, right? We knew about all of them. We knew about all of them. Once they started going back through the range, we knew it, right? And we had continuity going our way. Not very hard. Plus, when things occur matters, all right? So was this low below the precious 200-day? You bet it was. When was this? That was April. That's a new quarter. That's something I'd want to know about, right? The quarterly boys came in, right? So if we go to here, this is a yearly chart of the SPY. So like I said, it's like if Fibonacci were true, you would have everything ever would be be able to be formulated and calculated that way. So based on what I just told you, if you were a fund manager going way back, would you have known about all this stuff? You would. Here. 95, 2, 2, 2, 2, 2 up, 2 back in. Here's your 2-2 reversal in the year 2000. Down, down, and you would have been, continuity-wise, you would have already known you're in trouble there. Here, down, 2, 2, 2 down, but change is continuity here. 2-2 reversal back up. 2, 2, 2, financial crisis, 2-2 reversal down. 2 down, but then change in continuity. See these 3 years? They're an outside bar of all of this. Then you get your 2-2 reversal here, you're back up 2, 2, you would have known by red here to have some caution, right? But you're still 2 in your way up, right? Then you had your 3, and on the 3, you would have had a 2 down here, but you would have protected yourself, but then you can know to hit the gas again when you go up there, right? Then we had pandemic, opens here, goes 3 and comes all the way back up. One thing you'll hear me say is once a 3, always a 3 can't not be. If they sold down and paid up, they might do it again. Thus the name broadening formation, which they did. And we knew about that because the quarterly had already turned back to turn back green. They were buying, right? They were certainly buying. And what were they buying? Let's take a look here. Okay. Where are we? Okay, so based on what we know, if you look at Wayfair, look at this. Look at this here. 2 up, 2 down. Just annihilated, right? After this big 3 in here, right? Do we know about that? So Wayfair, here's my Wayfair. Yeah, Wayfair, okay. Here, when it was recovering, was the pandemic bad for these guys? No. 2 down, 2 up, right in April. We knew right about that. We knew when we had that reversal on the month, we knew about that. And then here you see the 2 up, 2 down, right here. That triggered all of this, all the way back down. You ride them up, ride them down. Rob blocks. One thing, little word to the wise, never in January 1st give your pick of the year. This is Josh Brown's pick of the year. I was like, is it? Because, oops. Is it? Because you see that, there's your 212 monthly. This thing's gotten annihilated. It broke that, and we knew about it. 93.27. This thing's down to $20, right? It's not even half a year. Carvana, here's a good one. This is a yearly chart of Carvana. Look at this stuff. So what do? Is I make a macro video of all this stuff once a month. So you know about all this stuff, right? And Carvana, that broke at 194.70. It's down to 46, right? Good stuff to know, isn't it? How about Netflix? This is a good one. How's the high? That's a 2 up, 2 down reversal in Netflix. And that broke at 640. It's Netflix. Where are you at now? 140. Here's the yearly Netflix. Did we know about that 2-2 reversal? We sure did. We sure did. The year broke at 478.54. So you could already have been in at 640. Does Netflix have buddies? Does. Amazon. What's that? That's a 2-2 reversal on the year. Did we know about that? We sure did. Let's see, where's my Amazons? Anyway. How about Facebook? Is that friends with Netflix? Sure is. Is that a 2-2 reversal on the year? Sure is. Do we know about that? We sure did. Is that still good? Yep. Now, here, if you go to the weekly, or the monthly here, during this, do you know how many guys came on CNBC calling bottoms? I was like, hey, bottom dude, that's going down, man, hard, right? We call that deep continuity. When you have that, you're not turning that around anytime soon. And then you have this, where it tried to go 2 down and come back up. And then here, when it failed and went here, that baby's going outside. That's going to be a 3. boom, full time frame continuity to the downside and take her down. We knew about that because here's the weekly. So the weekly goes up into here, makes that slight higher high, and then here in the weekly goes down. Once it goes down here, then I don't know. But I know that these are going to become an outside bar of that. I know that for sure. How about Shopify? There we go, Shopify. And this is a real fun one because Shopify, where's my Shoppy? Shop on the yearly, 2 up there, 2 up, 2 down, right? Annihilated on the year. That's what, 1,100, something like that, or was it? 1,005.14 down to 377, all right? Real nice. So, anyway, so some of these things really getting clocked here. Some nice charts for me to poop on. And it's not just these. You know it's been Peloton. You know, all these things getting destroyed. And when you know about continuity, you don't get in the way of this stuff, right? You know that this stuff is tanking, right? So you get out of the way. It's like, this is full time frame continuity to the downside. The machines are hitting bids, right? Then you wait for a new time frame, right? So what we'll say is that every day is like a new month to us. So where are my charts? So I know you're thinking, Rob, you're just a big old disaster girl, right? You're an old Chicago Stock Exchange short guy. You just come in here and just like to destroy things. And I'm like, well, the good thing about it is that things tend to go down faster than they come up, right? People fears a stronger emotion than greed, right? So we like that. And so I found this kid and his Halloween parade in my neighborhood, and I was like, yeah, puking Dow kid. I'm like, I love this guy, right? But it's not all down, right, this year. So the good part is we know what to look for. We know what buys and sells look like, okay? Definitely. So I think we omitted the checklist, but we have a checklist. I already know what winning and losing trades look like. This is all you got to know. If you're trading a 1, you're getting chopped up. If you're fighting a 2, you're going to get buried. If you're ignoring a 3, you're going to get destroyed. If you're fighting continuity, that's a losing trade. Winning trades look like this. 2 in your favor, 3 in your favor with continuity, and time frame continuity in your favor. That's the difference. If you go back, for people who have never heard this before, go back to all your trades and you'll see I'm right. This is what winners look like. This is what losers look like, period. You have to have some continuity to win. So, see, I'm not a big old disaster girl. How about AMR? This was a nice one, huh? This one 2 years ago, it broke at like 12 bucks. Now up to 170 or whatever. But as far as this year, what did we know to be true about a reversal in the year to the upside? XLE, energy. That's your winner, right? And we already knew about it last year because of this. We already had continuity. And now it's a 2-1-2 yearly reversal in XLE. And it triggered on the first day of the year. So if you think we're just a big bash and short selling dumping on these puking NASDAQers, we've been long this stuff because this gives you the signal. Now, there's something called a simultaneous break, all right? And this is how you gain high probability, right? The highest probability trades are simultaneous break. And what that means is almost all the 2s are breaking in the same direction, in the same sector, right? It can be the entire market, but here, you'll notice, Oxy broke at 33.75, up to 65. How about Chevron? 2-1-2 reversal over 119.34, trading 170. Exxon broke over 66.38, trading 91.61 when I did these slides last week. PXD already jumped the gun. No reason to believe this thing was going down. PXD already went 3 last year and now kept blasting. So we knew about that. So when I talk about this in Valero, the reason that this is a simultaneous break, almost every energy stock is 2 up on the year. Why is that important? I'll tell you why that's important. It's important because it tells me that institutions are buying them across the board. They're not discerning between companies and saying, well, I like Conoco over Exxon, and I like, they're buying everything that's got a drop of oil. That's something I'd want to know about, right? That's very high probability and really hard to turn around, right? And I know these are yearly charts, but these happen on a daily basis. They can happen by any time frame. We'll see them on a 60-minute basis. And what that tells us is we've got that amount of time to go after them, right? That it's going to last. We call that in force, right? So you have, and it can be across the board in, S&P and all the sectors. Like when you'll see all 11 sectors are down on the same day, the market's not turning around anytime soon, right? You got to have some leadership, right? So it's really important to understand that. Now, we go to, what do we got here? XLE. So we also had a simultaneous break to start off the year. So you're going to see this starting off the year. Here. See this 2 down, 2 up? It also came after a 1. We call that a reversal strategy. See this 1 consolidates. They attempted to break it to the downside, but weren't weak enough. And then boom, 2-2 reversal here to start the year, right? So you had that 2-2 reversal on the week, on the month, trigger, actually, at 57.87. And if that works, the yearly break was at 59.41. You can add there. Now we have 2 signals in force. And everybody's doing it. Here's PXD joining the party, 2-2 down, 2 up, right? You're not turning that around anytime soon, I'm telling you. And so that's really important. It's also important that we look for these combinations. We want to have as many of these signals triggering as we can. So we can have the daily, trigger the weekly, trigger the monthly, and it's in force for as long as that bar is open. So a monthly signal is good all month. So we can continually look for those shorter time frames to reconfirm that. So we'll look for shorter term, like daily reversals against us that reset it up, right, to go back up. So what is what I do? And how accurate is this stuff that I'm showing you? Because it looks pretty damn accurate, doesn't it? What I'll say is, I make a short video every night. Because of 1, 2, and 3 in time frame continuity, we can communicate very quickly. All right, I'm not sitting up there talking about stocks for 3 stocks for 15 minutes. So we got another tape for you to see. Here's 1 minute and 53 seconds.
Hello, everyone. I'm Lupton with the Smith in the Black, and we got the SPY. Couldn't quite go 3 on the day, just chopping around in here. So we really want to see how do we finish this week off, right? Right now, right back dead in the middle, right? Starting off the new month. Because we want to see which side we're closer to for next week to go to. Because the QQQ here is closer to shooter counter's hammer. So we shall see, because we're still opening the new month handily so inside months on everything. So we know that. We got some earnings coming out. We're waiting on AVGO, and so far doing nothing. so far, but we'll see if that can get anything going. And Marvell, the semis, because SMH stays inside day, and so does NVIDIA. So these things so far are doing nothing, but we'll see if there's anything that gets those going. Intel stays as an inside day. You've got Facebook stock as an inside day. MU, the semis, you got some distance to take that out, at least moving around a little bit. We got Roku here. See if that wants to roll back down. You've got UPST here. See if we've got any more ripping in there, because it's still flirting with that. It's still inside week and up, so we'll see how that goes. The energies, you got Oxy inside day, just holding gains up in there. Home Depot, keep an eye on that. See if that wants to come up and triangle these guys out, or just triangle these guys back out. So we'll see. We go to Wynn Resorts, a proxy for some of the pandemic names inside day. And Northrop Grumman, see if they want to gun this thing, if they've done what they want to do for a while. But it's like Marvell's tanking right now, but we'll let them open tomorrow and get to the weekend with the macro vid and the weekend vid. All right, that's going to do it for today. I'm up to this, Mr. Black.
All right, so for people new to this, that's total mumbo jumbo. You have no idea what it's talking about, right? People that do know, there's a lot of cases will go either way once that one breaks, depending on when it occurs, right? So if you take a look at the next slide, what did I talk about? I talked about the SMH and a bunch of semis, right? Potential simultaneous break, which we got. But SMH was down 2.93%. Facebook was down 1.4%. MU was down 8.14%. UPST was down 14.7% off that inside day. Roku was down 5%. Intel and Home Depot were flat. The two things I talked about long, Northrop Grumman up 4.3% and actually up 17% the next day. That's one day. The only people can do that in their entire career? Not many. But we can do it pretty often. But don't take my word for it, right? We've got at Benzinga Pro, and unfortunately Ryan Faluna's not here. He's been very helpful with us because I know how hard it is to try and convince a community that there's a different way to do things after they've been doing it for 100 years. But this is how things are going to trade. It's just too efficient. Once you see this, you can't unsee it. All you see is 1, 2, 3 and combinations thereof and time frame continuity because that's all there is. And that's all there can ever be. You can't change that. And even if the whole world knows it, you can't change it. So at Benzinga Pro, I'm in there. We got a chat room in there. Ryan has interviewed me maybe 3 or 4 times. And there is 9 hours of his interviews with strat traders. Now, everybody's different. Even though, the strat is the same, everybody trades it different. It customizes itself to you. Right? He's even got an interview with Jim Bradley. And if you've never heard of him, I call him Lightning Jim Bradley on Twitter. He only has 15 losing days since the beginning of the year 2000. He only has 1 losing day this year. And his interview's in there. And he trades usually less than a minute a day. And that's how efficient you can be. Not everybody's mind is going to think in those terms, right? Like I said, that's why you show the monthly charts. Some people are like, how do I want to invest? All right. So Benzinga Pro has got, I'm in there during the day. I'm running my own shop, but I'll stop in there. But I said 9 hours of interviews. And one of the good things is you want to see what kind of a strat trader you are, right? Because there's going to be similar people like you. Not everybody's going to be trading like Jim in 1 minute. Not everybody's going to be trading, Amazons or whatever like that. So one of the things about me in my chat room is I'm always discerning people into their proper groups. Be like, these guys trade like you. If they post, this is who you want to listen to. Because a good chat room, I think, should be pretty silent. Noisy one means nobody knows what they're doing. Anybody like this? Anybody think this is a buy? I'm like, you don't know what buys and sells look like? What are you doing? Right? You have to know that, right? Trend Spider, Jake, you in the house? Maybe he's out front. But Trend Spider, Dan Ushman was going to be here too, and he couldn't make it. But Dan is the CEO and head programmer at Trend Spider. And he lives about, I met him online. He's like, yeah, I'm in Chicago too. And I'm like, we should stop by the office. And he's like, well, we just had a newborn. And I'm like, well, where are you? He's like, oh, I'm in Ashland and Wilson. I'm like, dude, I can see you from here. My office is 2 blocks away. Come on over. And he walked in. The first question I had, I'm like, does your 60 update at the top or the bottom of the hour? He's like, no one's asked me that before. And he's like, bottom. I'm like, good. And I started to show him all this stuff. And he was like, his eyes just kind of glazed over. He's like, interesting. I'm like, let's see. Watch this. Where's it going? Up there. You sure? Yep. Watch this. In 3, 2, 1. Right now. He was like, I've never seen anything like that before in my life. I'm like, now you have. So then he brought Jake back and showed it to him. He's like, we're definitely putting these signals in our software. So not many people have their signals, and I don't like to use indicators. I say signals. Not many people have their signals put into major software. I have, all right? And so they have the 1, 2, 3 right in there. And you can search and go 1, 2 and find those 2, 2 reversals. They've got it all. And, we have a Facebook group of over 6,000, and they've got code for everything. I mean, there's some real madmen out there for all this kind of stuff. All right, so like I said, don't take my word for it. This is an email I received a while back. Okay, and I am a financial advisor, and I work at the firm who shall remain nameless. He's like, okay, Merrill Lynch. He's like, I manage $1.5 billion in assets for my team. 80% is traded with discretion based on clients' risk tolerance. I believe the learning the strat is and will benefit those that trust me with their financial capital. My goal now for portfolios is to consider the strat in everything I do. Merrill Lynch, $1.5 billion. Think I convinced him? I think I did. I got a buddy out in Silicon Valley that I've been hassling about this too. And I was like, dude, you got to check this out. Dude, I'm changing the industry. As a group, we are changing the industry. Eventually, everyone's going to trade like this. It's just too efficient. And he looked it up and was like, dude, your digital footprint is huge. He's like, he Googled me. He's like, there's strat everywhere. And I was like, it's all organic. I'm like, you would have had to pay millions for this. And I'm like, word of mouth, man. You make people money, they talk, right? And I'm very proud of that. But don't ask me. Ask the University of North Carolina. I'm going to be addressing their honors program on the Strat this fall. I've been talking to the professor for a long time now, and he's like, we want to put this into our investment club program. We would enjoy working with you. And I'm like, you got it. University of North Carolina, stamp of approval. So here's what you do, right? You learn the Strat, all right? You make the money. You tell people about it and say, because one of the great things is, like I said before, we can communicate very quickly, right? Unlike any other place, any other shop has got to give some, well, it could hold support and blah, blah, blah. It's like 1, 2, 3 combinations thereof, continuity. When is this occurring? Do we have a simultaneous break? Period. So you learn this. And I promise you, for the people who raise their hands first, once you go back and look at charts, you're not going to see anything different. This is all you're going to see. You're just going to be like, that guy's right. That guy is absolutely right. That's all there can be. Now that's all I'm going to see. And then do you know what you do? You train your kids. This is AA Trading Partners, LLC. Allison and Abby, 14 and 12. They've been trading the Strat for 4 years. Here's when they started. Here they are today. And Abby pretty much keeps the books. Allison hits the keys. She's damn good. And here's when they started. We like to say get when we got something moving. We heart the Strat, and they cut off Abby's hand right here and here. You see here, when they first started, I called them the iWatch girls. After 2 months, they bought themselves iWatches. And their dad makes them keep most of their money in there. But that's what you do, because it's like a video game now. You know, and they don't have any preconceived notions. Well, I don't know, they miss their earnings, and I don't know, I like the coffee. Buys look like this, sells look like that. And, you know, it was funny because I do a coaching session, 1 hour each week. And one time their dad texted me, and halfway through, Allison said, Daddy, can I leave? I already know all this. So very proud of them. So here's my desk. And some people are like, oh, that's such overkill. I'm like, when you know the Strat, there's so many signals you can't get to it all, right? It's a matter of trying to find those simultaneous breaks that have the higher probability. That's what I'm doing all day. So I'm air traffic control because we believe trading is much better as a two-person job. What I mean about that is that we all think exactly alike. I'm calling stuff out, you hit the keys. We will destroy people that have to analyze and execute at the same time, right? Because what that does is it mitigates mental error. You know what to do, right? And then oftentimes I'll make sure people stay in a trade. I'm like, well, I don't know, I want to go to lunch. It kind of stalled out. Still good. It's still good. What are you getting out for? You're letting somebody else out. That thing's still good, right? So you'd rather have more hands, more eyeballs, more keyboards watching all your stuff, right? You would. So during the day, I'm on the headset 7 hours a day. Then I make those short videos at night. On Monday night, I come back on after an hour for another hour to train people. I do something called the Strat Attack Show on Tuesday because on Tuesday, I can see what things have reversed Monday's stuff, would they sort of turn around Tuesday, and the things that continued. That's what we want to know about. Who's still to and who went to against. So I do the Strat Attack Show. On the weekend, I make a more comprehensive video about all the sectors and what's going on. Once a month, I make a macro video of all those monthlies and quarterlies that we were looking at. But I'm pretty much on the headset all day long, directing the traffic. So we decided for coming out here for a half year, $499, 6 months. And what that does, I'd like to think that the power hour training session is worth it alone. Right? So you got your code there, FinTwit 6, right? And just the coaching alone, because like I said, that not only do you have me, but a large community that's been doing this a long time, all right? So we can, you know, so I can focus you with those types of people. It's really helpful. So, all right, so I'm glad y'all came out today. Just about out of time, but since it's Vegas, for coming out today, I'd like to thank you. Thank you very much. All right. All right.
Thank you so much, Rob. It's been an honor really learning about the strat over the last several months from Rob, from Sarah, and so many others. If you were listening and this intrigued you, find Rob after. Ask him some questions. Guy loves to talk. All right, with that being said, we're going to keep it rolling here. We all know this event didn't just come together by chance. Benzinga was a huge factor in making this happen. I'm sure you've all learned who Benzinga is and what they do at this point. Let's welcome to the stage Nick Chahine, the Chief Option Strategist at Benzinga. Give it up.
That sounds like a fancy title. Chief. All right. I'm a little woozy, got a little migraine. Medicine knocks me out a little bit. Okay. So a little bit about myself. I'm not from Wall Street. Okay. Not from Wall Street. I picked this up on my own. I was an electrical engineer, and then went into finance and was investing all along. And then I picked up a few things here and there, and I had a few aha moments, I want to say in the last 10 years. And it was clear that a lot of people are doing a lot of things wrong and overcomplicating what can be pretty simple. So I'm going to share with you just a few simple concepts that you probably already know. And it might sound insulting to some people, but in the end, it's there are things that we already do know we need to do, but we kind of don't stick to it. So I'm just going to simplify it, dumb it down. And what I do every day is I work with Benzinga. I found them about maybe 12 years ago, and we've been collaborating. And I have a big group that that follows me, and together we're doing something that the retail investors can do on their own, but probably shouldn't. So in the end, I'm going to tell you to collaborate if you can. Find a good group, because you'll be more successful. You will make fewer mistakes. So my goal is to try to highlight opportunities and stop people from making mistakes. I see a lot of people come up to me and say, hey, what can I do for this position that's down 90%? Well, it's kind of too late. You know, how do I hedge it? You can't hedge it. It's dead. So you have to not do the same mistake later and consider this as tuition. So let's see here. Don't do this often. Okay. So I want you to think about, how can I level up my game to be not specifically a pro, meaning making a living out of it, but if you can, that's great. But also to think about the things that professionals do that you should. And they're simple. You don't need all the tools. They help, but don't get too many tools, you get confused. So first things first, you need a method. If you're not working on step 1, 2, 3, 4, you're winging it. You're pretty much winging it. And this gives you some confidence. Once you know you have a method, even if it doesn't work one day, you know it's been working, and this one day is not going to change your mind. Like, I did some things yesterday because I was busy half the day. I exited a couple of positions way too early. Okay, so I left money on the table, but I'm not upset about it. I did the right thing. It wasn't perfect, but I'm going to have to do it the next time I face the same situation. So this gives me confidence. And if you don't have the discipline to stick to your method, it doesn't pay to have one. So first things first, I'm going to give you a couple of minutes to try to define risk. If you were up here trying to teach me what risk means, think about it. What kind of words would you use? How do you define and how do you manage risk? And I bet you everybody here knows the answer. It's just a matter of putting it into simple, I'm going to give you a clue, 2 pieces. So think about what these 2 pieces will be, and then I'll tell you my opinion of it. So it's everybody kind of knows what risk is. You know, if I jump off here, am I going to break my leg? What are the odds of me making it? So those are the 2 pieces that are important. First, consequence. What's the worst case scenario? If I don't know that, I shouldn't take it. Like, nobody should ever short a stock outright. If you're a home gamer, the upside, the maximum risk is unlimited by definition. So how can you take that risk? For me, it's a no-no, especially after the Reddit debacles. So hedge funds are going belly up or getting hurt badly for one reason or another. So when you buy a position, when you buy a stock, when you buy options, whatever, 100% is your maximum risk. So I know I can lose my money. But when I short a stock, it's unlimited. I don't want any part of it. So I don't sell naked calls. I used to, I stopped. And I don't short stocks outright. There's no need. There are positions in the options world that kind of do it, but with a finite amount of risk. So first is the risk size. How much can I lose? Everybody gets this right. So the other part that people completely ignore, which is, you know, if you ask, how do you manage risk? Oh, how much I can lose? Yeah, I got that. Everybody gets this part right. But the other part is the odds. Well, what are my chances of winning or losing? Because that is the piece you actually manage. So if I take a position, options traders in here? Okay, so in options, the easy part is that you can get your odds. Like, what are my odds at any point in time? You just look at the delta column. It's roughly your odds of success. That's the Main Street definition of what a delta is. What are my chances of winning or losing? You have to check that every day, every minute. Depends on how fast you trade. So the first part is the how much. That's a one-time decision. It has a subset. We can talk about it later, but it's a one-time decision. You make the decision, okay, I'm willing to lose 5,000 on this trade, and I'm okay losing it, and I will survive it. But then the second part is, what are my odds? That changes minute to minute. So when you take your position, you assign yourself a number in your head. Make sure you update that number. Because if that number is too low, and too low, what do you mean? For me, if the delta is below 0.2, it's too low. I'm just hoping for the best, and my money's there waiting to die. So I need to do something with it, redeploy it somewhere else. So you manage your chances. Now you're actively looking after your soldiers out there. So you don't want to leave them to die. If they have very little chance, even if it's 1/5 of what you deployed, it's going to die unless you do something with it. So you should change it. So risk management involves figuring out what are my odds of still succeeding with my original thing. So manage it. Don't forget to manage it. Too often I get people, because I work with thousands of people, I get it hundreds a week, no joke, they kind of like want reassurance to do the right thing. They know what to do. They just want the reassurance to do the right thing. So it's silly to start. I'm pretty sure you've been listening to all kinds of stuff today and yesterday, but to start with a simple definition of risk, because we skip it. That's like step one. Now, I said there's a subset of that first one, which is how much. In this environment, when the VIX, the fear volatility, is at 30, it means nobody knows anything about anything. Anything can happen at any minute, so you have to be humble with your opinions. If you usually are very confident, you should knock yourself down a notch and not go all in. So nobody should average down ever, in my opinion. I've known 3 unbelievable traders in my life, and they would never ever consider averaging down. If they have an iffy situation, they average in, not down. So if you decide you want to own 100 shares of the stock and you think this is perfect, take half of it or a piece of it. Leave something for later. So averaging in is okay. Averaging down, not my jam. So as far as the rest of it, we can go into just little silly habits. Homework. I do a crap ton of it because I do a webinar on Sundays for my subscribers, they send me what tickers they want to see and end up with hundreds. So Saturday night, I'm charting. Sunday night, morning, I'm presenting, and video with it and a reference sheet. So homework, if you can't do it, farm it out. Find somebody that can help you do it. And if you are an investor that doesn't use charts, I think you're making a mistake. You're leaving a great tool out of your toolbox on purpose. Whether you believe it works or not, whether you think the technical analysis is garbage or not, I mean, let somebody else help you. If I get this, it's not going to matter much in the long run, well, then where's the fire? Spend another 5 minutes, and maybe you'll be able to buy double the shares later. So homework, you can't get away from it. And when I do homework, I set alerts. I have hundreds of alerts, and they fire off every day, which is me, that's the mental note for me to go and update it. It fired off, that doesn't mean I go trade, I go check it out. Maybe I reset it for later with more information. So let it do your homework for you. And I have a stupid acronym, it's NTNT. So basically this stops me from doing an idiotic thing. You shouldn't ever take a trade that doesn't have a real reason for it. So the NTNT is no trigger, no trade. So you say, well, I don't do charts. Okay, so it's no thesis, no trade. So whatever you want, have a freaking reason. Don't ever take a trade without a reason. And a thesis is, I thought it was going to go up. No, that's not a thesis. I thought it was going to go up because of X, Y, Z. Why? What is it that prompted you to think that this is the right time? Maybe you think that the company is coming out with something great. That's a good reason, but you have to revisit that reason, because once the reason goes away, you have to say, okay, that trade is dead. I have to leave regardless. I did that earlier. So then once the trade is set, okay, I have another stupid one here before we go on to the other one. A litmus test. So if you have a good conscience to take somebody else's money and put in that trade, okay, so maybe you have good conviction, unless you're a sociopath. So the idea is my mother is 90. She lives in Lebanon, so she's definitely hard up for money right now because the banks are broke. So would I take her money and put it in the trade? This is where, if you can say yes, then maybe that trade is worth it. Otherwise, maybe you shouldn't do it. So manage your odds realistically. Please don't forget that. If you don't trade options, those of you who didn't raise your hands, get yourself a source that gives you options tables. Because if you buy, I'm going to throw a name out there, if you buy app stock now, thinking it's going to be 180 in July, then you can see how realistic your expectations are. You go to a column called Delta, go to the 180 line of that month, and see how realistic your expectations are. So even if you don't use options to trade, use the information in the options table. It gives you what the market makers are thinking, because they take care of their money. And you read it inside the options chain. It tells you where the market makers want price to be. They want to screw everybody. So you figure out where you can screw everybody, that's where price is going. And it's in there. And if you don't know how to do it, farm it out. People will help you. So taking a trade, that's the first step. Stopping out, that's another mental hurdle. I had a problem booking profits. You see it green, and you say, oh, it can get greener, and then it's gone. So with a VIX 30, that happens often. So what do? You stop out before it happens. When I take a trade, you should have two things. One is how much pain am I going to take? And it's different. It's different from person to person. It's different from situation to situation. On Friday, I had a position, and it was binary from Thursday night. I saw something in the small caps, or small craps, as I call them these days, that told me that maybe we're going to pop on Friday. So I took a long position, and then we did pop on Friday, and I was faced with the dilemma. Do I close it, or do I let it run? I decided to close it. But I was willing to lose half my money on it because it was a fast trade, and it was a binary trade, and binary is coin flip. So I made the decision that I would see 50% pain on Friday morning before I call it quits. Normally, I'm not that aggressive. I see 20% loss, maybe I get out. So find numbers that are comfortable to you and numbers that are appropriate to the right position. So stop out when things are good, stop out when things are bad. The more you do it, the easier it gets. Oh yeah, I'll take it off. Before, I was like, do I book it, do I not book it? Practice. So booking profits, that's what we're talking about. During the high VIX trading, I came up with something new. Just another stupid acronym, ABCs. It's not here. I'm doing it on the fly. And so ABCs, you can change the A to B whatever, and it'll work, but it's an easy ABC thing. So when we get huge rallies, like Friday, in this environment, I would say people should add protection. If they were crying 2 days before that, oh man, I wish I had protection. And then you get a 4% move in the market, and then you do nothing. I think you should add protection. Wherever your pain was, you should protect it in case that was a one-off. And then second, the B is book profits more quickly than normal. So if the other day I shared a long TLT, which is a long bond trade, which is counterintuitive in a rate hike environment. But I thought that Powell was crazy, out of his mind, and he's going to be shut down by the market. And the next day, the TLT popped. I immediately sent out a note. I said, I will close it because you're not guaranteed this thing is going to last. And sure thing, the next day it reverted lower. So maybe in the long run it will work out, but that was a trade. So book profits, and that's the B, faster than normal. And the C is close your losers. So I did that also yesterday. I had a options position that was under fire in Tesla. And we had a big pop. I think it was Tesla or AMD, I can't remember. And the pop got me out of trouble. So I could have waited, and it may have turned out okay at the end of the day, but I got a reprieve, a gift, and I took it. So it was under pressure, it was a loser. I got out with a scratch. So that was something we need to do more often when the VIX is this high. So this ABC thing is on the fly. It's not here, I don't think. Okay, so do's. I'm going to repeat myself because it's so simple that we need to stick to the very, very basics. So the do's and don'ts, have balance. Many times I get somebody that says, I have a trouble, can you help me with my portfolio? And they give me the portfolio and it all looks like the same stock. So if you're long Affirm, SoFi, PayPal, Square, IWM, whatever her name, ARK-K, ARK-F, you're long the same stock. So you get one bad day, the whole basket is toast. And you have no hedges. Have balance. I'm not saying have shorts and longs. Have different kinds of stocks. Have some energy. Short some energy. Short the SPX or the SPY. So that on any given day, you're not completely toast. Have some bond trades. Have some PBT, TLT, something that puts, expand your basket of trades. So having the same stock, I think, opens us up to some pretty bad days. Pretty good days, pretty bad days. But in the long run, if you're doing options, the bad days will outweigh the good days, and it'll be difficult to make money. So, and spread the risk. I mean it. Use spreads whenever you're unsure, if you're doing options, and use spreads differently, like time, like buy a little bit here, a little bit there. Put part of the position and part of the position a little bit later with more information. I'll tell you, with crypto, I do trade crypto. I think you should look into it too. Side note on crypto, if you're a hardcore, staunch hater, you might hate life in the future because everything in our lives is going digital. Why not money? Money is going digital. There is no doubt about it in my mind. So maybe it's not crypto that's going to be the currency, but everything that's going, these crypto, everything that's happening now is laying the groundwork. So I do trade it, and it's just a trade. So I did a video in November saying it's coming down towards 20, and I want to buy in 3 stages. I said I'll buy at 33, I'll buy at 25, and then I'll buy my final buy around 20 or 19. And I have my second buy this week. So I bought at 33, ran to 46 or whatever, 48, I think. And then I bought again this time around 25. So I spread my risk over time. So if you have a thesis, just spread your risk. And spread the kind of stuff. If you don't have crypto, just dabble in crypto. You don't need big baskets of money. You can just dabble with $100 if you wanted to. Just get to know it a little better. So spread your risk across asset classes, across opinions, across styles. I don't do a lot of shares purchases, and I bought some Upstart on this crash because I figured I'll sell some calls against it and try to create some money out of it. So if you don't know Upstart, it's a crazy stock. They lend money with artificial intelligence, and but they take the money, they provide loans, but then they usually sell them off. They tripled their business. They grew business, I think, threefold, and the stock fell 60%. I mean, that is insanely wrong. And that's because somebody feared the fact that they're finding fewer lenders to off the paper off their books, so they ended up holding more paper than they should. That's why the stock got hammered 60%. I'm willing to take a chance. So I've traded it 3 times well already, and at its higher prices, I figured I can buy it for $30, whatever it was, $34. So I'm spreading. I usually only do options, so I dabbled into crypto and I dabbled into shares of a stock I usually don't. And averaging in, we've been talking about that. Common problem sources. So don't average down. Please don't average down, because you're basically making your problem bigger unless you know something materially different that gives you the confidence to add to your problem. Why would you want to add to your problem? That's not me. And don't hope, especially with the options world. If you're a buyer of options, if you buy and hope for a rally and the rally doesn't come, don't add. And also don't just buy because you think the rally is going to come. There are other ways to. So if they say most options expire worthless, that's the end of the conversation with me. I do not want to buy options. I want to sell them. So whatever you do in your career, if you're doing options, chase the opportunity to become a seller of options rather than the buyer. And you don't need a big account to do that. In fact, you can start with a tiny account because you can do smaller spreads to get you to confidence with making the right calls. Even if you use one contract on a small spread, you can make a big bet in your mind based on your thesis. So if you see something happening, you can put it to work with $50 and say, if this was $1,000, I would have made much better, but I need to prove my point. I need to make the system work. So if you see a hard floor in a stock, you sell a confident put spread right below it where you think it's a hard floor. And then next time, when you know you can do it over and over, you can make it a sold naked put and a bought call at the same time. That's a pretty aggressive way of going a long stock with not a lot of money out of pocket. So, but you can't just hope it happens. You need to have the confidence into building a whole system that gets you say, okay, I looked into it. For example, yesterday I was doing homework in the other room with Leif, and we were looking at charts. So we pulled up, I think, Ford and Facebook. Both of them look good to me for a swing trade opportunity, provided the market doesn't fall apart. So this is the underlying assumption under everything. And usually, last time I recommended Ford, it was like 7.5. I said, I want to buy calls, leaps, and sit on it. A good old American company is going to come back. And it went to whatever, 26. And then when it fell back down to 20, same people that bought it at 7 came back. Is it time to get back in? I was like, no. When do you get back in? Under 13, maybe? What? No, it's not going to happen. Okay. So now it's under 13, or it went. And now I'm interested again. And I am not sure it's a bottom because it must hold. Otherwise, it's got a disaster coming, which is improbable, but it's there. So as much confidence I have in the floor, I'm not going all in. Whatever I do is going to be tempered. So it will be a good swing trade opportunity. And the reason for it is somewhat technical and some other stuff I don't really understand, but I pay for the service and give it to me, harmonics. And I know how to use it really well. I just don't have time to learn how to draw it. And so fundamentals part scares me a little bit with Ford, but this I'm sharing with you like the thought process. So I have fundamental reasons for it, but a little shaky. I don't know if they can make the move from internal combustion engine to electricity profitably. Macy's had that same problem. They wanted to convert online. And they started taking traffic from their stores, which were profitable, to take them to sell online, which were not profitable. So their P&L got damaged. That's why the stock went down to whatever it went. So I think Ford and GM might suffer the same thing, but they might have maybe 6 months before it starts showing up in the P&L. But for now, I'm willing to take the risk. Technically, it looks good, but I'm not going all in. I did the homework. I set my alerts. I haven't set the full strategy yet, but if I wanted to own shares, I would sell a put, buy a call, but not all in. I'll take 50%. Same thing with Facebook, except I don't think there's a problem with Facebook's P&L. Monster company, it's inside the pandemic base, so it's shed its fat. Apple has not yet. Apple can fall another, I don't know, 30% maybe, air math, before it hits the pandemic breakout. That's pretty insane. Same with Google. Facebook is already in there. Netflix is way below that. PayPal is way below that, which is weird. Somebody know something about PayPal? I don't. What the fudge? I mean, the P&L, they're making money hand over fist. It's below March 2020 levels. How is that possible? It's just insane. Anyway, sidebar. So when you have a trade that goes against you, redefine it mentally. Redefine it, because then you're more likely to convince yourself to close it for a loss instead of just hanging on for it to come back to you all the way. So redefine it. Now it's a hostile trade. So how the hell am I going to deal with it? So if you're rolling it in options, don't make it bigger. Don't add to it so you can roll it with positive. Don't worry about it. You have to pay a little bit to get out of a painful position. So take a loss. Don't worry about it. Don't make it bigger. I had a position like that and I dealt with it. So redefine it as a hostile trade. I can't remember what it was now. Otherwise, I'll share it. So these are the ABCs, except they're CBAs. What's up with that, Nick? So those are the close on pops, relief pops. And you should know when a relief pop, it's 100%. They always retrace. So if there's a CPI number coming out, and then the stock market rallies after the CPI number because it wasn't a disaster, that's a relief pop. It's a relief pop that something bad didn't happen. That's not a good thing. That's like you take your shoes off and you go, it's not a good thing. So expect it to retrace. Don't chase a release pop. At least don't chase it, a release pop. And speaking of CPI, this week we had it, right? And the market fell. And people said that's why the market fell. I disagree. I have proof. It did not fall because of it. That day, the TLT closed up big time, which is the price of bonds, which means yields, rates fell. If it was a hot CPI, they'd be worried about, what's his name, Powell raising rates faster. The dollar fell and then recovered late in the day and closed slightly green. The dollar should have spiked to high heaven. It didn't. So it wasn't a CPI. It was just BS margin call covers, I think, or whatever, forced selling. So it wasn't the CPI. But that's what you hear in the news. So I'm going to tell you, stop watching the news for trading purposes. Okay, so let's put it all back together. I'm going to try to put it all back together. Like, how do we wrap it up? I think the headline said 5 things we can do to level up our games. So I'm going to go through it. So the NTNT is a absolute, you can't cheat. You need an absolute trigger. So don't skip it. Use the acronym. It's not mine. I stole it from somebody. I have no idea who. I think like 10 years ago I heard it. I'm going to give Fibonacci Queen the credit for that. And she's somebody that is popular. So it's no trigger, no trade. If you don't find a reason to get, if you're going on a hunch or going on somebody else's hunch, due diligence. Find out exactly what's the reason you're chasing and mark it. Because that's the only way you know if you're still wrong or right. If you're still right or you're wrong. And you should be able to change your mind. Don't skip that position, that spot. And then manage your risk. I'm going to assume you guys know to take risks that's not going to blow up your accounts. So I'm not going to mention that. So I'm only mentioning the second part, the odds. Be honest. Revisit it as often as you can. If you have another job and trading is not your life, a couple times a week, it doesn't take much on your phone. Just look at your odds. If you don't use options, start learning how to read an options table so you can make decisions on your equities. They help. Okay, so if you look at your order flow I was just somebody else was presenting something else over there, and they had a slide that was great. I knew it, but I never thought about it. So they showed price action on stocks, on the, whatever they were looking at. And then they showed order flow on stocks. And then they showed the order on options. And it's so much clearer and so much, it's first of all, it's static for the whole day. So you know exactly where the money is. And then you know where the new money is coming. So you look at it, there's so much information in there. It's incredibly profitable for somebody that knows how to read it. So I'm actively trading intraday live in my screen sharing with about 300 people. And we wait for the last 20 minutes to see if we can read the options flow. And you know exactly where price is going to go, most times. And then you can see all the options come in. If you see a huge put option order and price is well below it, you know the price is going to go right above it to screw everybody that just bought puts. Those prices are going to die. So manage your odds. Use options data to manage your odds, because when you buy shares, you give yourself in real life, you have 50-50 chance. You buy a share, you think you're a genius. The person that sold you the share thinks you're an idiot, and vice versa. So you think you know better than them because of such and such thing. And you think you have, in your head, a 70% chance of success. Why don't you give that a real number? The column is delta in options. Just look at the delta. The definition is convoluted, Wall Street jargon, not to offend Wall Street people here. It's something like the change in the options based on the $1 change in the underlying. Try to put that to work. It's the odds maker. If you look at the delta at current price, it's 0.5. That's a coin flip. You go away from 0.5, you go to your $190 call for Apple, and it shows 0.05. You basically have 5-6% chance of that happening, which is basically a lot of hope, not realistic expectations. So the delta column is chock full of information. Exit strategies, you should absolutely have them. So first, you get a real reason. Second, you find out what your odds are and you manage that. Third, you should have an exit strategy right away. Any of you futures traders? All right, so I bet his orders have 3, maybe 4 legs in them. Get me in here, get me out in the oh shit moment, and here's my target 1, get me half and trail the rest to get out of the whole thing, right? So when he takes a trade, nothing's left to chance. He either loses a few bucks or he makes his run. So exit strategies. If you do stocks, I get in here, you don't have to be surgically accurate, and I don't mean automatics, like I don't use automatic stops. I put alerts and I jump in and I do something with it myself because I'm actively managing it. So, but if you want to use automatic, it's better than nothing. So, but it's important to have, what am I going to do if things go bad, and what am I going to do if things go well? So let's see here. What's my next gem? Oh, okay. So growing your skills. This year, I don't, okay, so I said I'm an engineer, and I have a knack for numbers, and I'm good with geometry. So I fell in love with charts. And now I put my skills up against all the Wall Street guys. I humbly do that because it's totally fun. It's like a game. So growing, meaning growing your toolbox that allows you to do your job much better. So I used to be completely fundamental, and then I delved into options, and then I started doing some charts, and then my charts had 15 indicators on there, and that just got too busy. I'm not using any of them. And then I threw everything out and I started scratch. So now I don't need anything on my charts. I can look at charts, and my number 1 tool, can anybody guess? I'll be floored if you guess. No? No. My eyes. So I just challenge you, the next time you look at a chart and you decide to take a position somewhere, just look left on the chart. Just look left. Don't use anything. Just look left. What happened the last time the price was here? And if you find a peak from which it fell, or a ledge, price was there, don't buy it. You're buying it into a prior accident scene. Just look left. Or if you just crossed a place like that, then that's maybe a momentum trade. They're probably going to burst, dip a little bit, test it, and go up. So just look left. So number one tool is eyes wide, because my number one thing on charts are levels. Know the levels. Like, know where you're at, know what's coming up, know what's behind you, so you can get comfortable. So for example, any Lucid traders, Lucid, the stock, LCID. Okay, there you go. So Lucid last year, anyway, spiked to high heaven. So if somebody had a chart with a short period of time frame on there, they would have missed it completely, that it was there before and it crashed miserably like 3 times. So they bought and they got stuck. Well, in the end, maybe they'll come out okay after 15 years. But meanwhile, they're stuck. They say, okay, in the long term, it doesn't matter. But you could have bought twice as many shares. So levels, my number one thing, levels. And then patterns, if you can pick them. That would be the second time. For example, when I see a breakout from a level, okay, so that stock has some run to go, or breakdown, then you want to know how far, and that's where patterns come in. The patterns maybe, you've heard of the very famous ones, the head and shoulders, the inverse head and shoulders, the cup and handles. I came up with a couple names, ladybug, and things like that. So whatever it is, grow your tools. If you don't do charts, join a group that does. They're not complicated. The basic ones, the concepts. I have people in the other room that I've been chatting with online, and I met them for the first time. You know, this one guy came at me and says, look, check it out. And he's showing me his laptop. His charts look like mine. Simple, hand-drawn lines. There's nothing complicated. However, I did add a couple tools this year because of the people that earned my subscription. They said, you should check out this one, and you should check out that one. So I had no exposure to algo. You know, I hate saying the word algo trading. Everything is algo, right? So if they say the computers do all the trading, that's algorithms. So of course, everything is algo. So I had no exposure. So I picked up a tool that does that for me. It's like $50 a month. So this tool I would pay for because it gives me something I didn't have before. And I would use it only specifically for intraday trading. That's it. Because I don't know what the order flow is like, and these guys give it to me. So I use it. And I added harmonics. I had a couple of guys and a girl in my group that were unbelievable harmonics traders. If you don't know what those are the ones that are called crab, bat, alt bat, shark, Gartley. So people have spent years perfecting these patterns that show up all the time, and they have very, very specific ratios. It's impossible for me to learn how to draw them on the fly, but there's software out there that does it for you. They just show up on your chart. Boop. And then what you do with it is where the money is. So if you use it as a trade alert, you're going to lose money. But if you spend a couple weeks studying how to use it, it's almost foolproof. Almost foolproof. It gives you a path where machines are going to follow. They're predictable. So grow your level of skills. If you don't have it, find a group that does, which probably leads me to the other one, which is collude. Collusion is good. Collab. Get together with a whole bunch of people, 3 people, 4 people, a whole group. My group is 315, I think, the highest last week. And my screen share, everybody in the chat room, we're all these, not a lot of noise. Don't join a Discord group where everybody's shouting trades. Nobody's allowed to say anything like, oh, I just booked, unless they actually said when they went in. So if they want to help them, they say, I just shorted Google, I just shorted Apple or something. And then they say, I just closed my short for this much green or this much red. So collaborate. I will never go back to trading alone. Even though I don't need help with my trading, first of all, it's a lot more fun and it's empowering. So here's the biggest advantage I got, the biggest benefit for me. When I'm alone, I forgive my own mistakes way too quickly. So I half-ass some things and jump in, and nobody's going to know about it. But if I'm sharing my ideas, guess what? I'm going to be a little bit more picky because I'm in a room and I'm going to be accountable to some people. So collaborate. I don't trade alone. It's a tough game. I mean, they're ganging up, whoever they are. They're ganging up And there's always two sides to every coin. So I saw this on Twitter one time. I want to say like 7 years ago, somebody posted, there are two sides to every story. And there was like a drawing of two guys talking and two wolves talking. So the two guys, one, hey, Bill, I think I domesticated the wolf. Right? And then the two wolves are talking. The one wolf is telling the other, hey, I just struck a deal with these guys. They're going to house us and feed us. And all we have to do is rebrand as dogs. So there's, don't forget that whatever you're doing, somebody thinks it's a bad idea. Your trade has another entity on the other end. It's not always a human, but it's there. So this is what I think I had planned. I don't think I have anything behind that. There's no spiel after that. I do work with Benzinga. The service is where I write up the market before it opens. So I basically made myself available 24/7 to whoever wants to listen. And my message is very simple. I'm from Main Street trying to make it work and educate people who don't have the time to do what I'm doing. I got lucky and I'm here. So the group gets a write-up from me in the morning before the market opens. And it shows all the charts for the day and the blurb as to what I'm looking for. And then middle of the day, I share a trade idea via video, like 15 minutes. And it's usually, here's an idea, you can do this in 4 ways: buy stock, buy calls, buy call spreads, sell put spreads, or any combination of thereabouts. And the live room is open all day, and the chat room is open, but static, that's not live. So anybody that wants opinions or help or share ideas, they're more than welcome in the group. And it's there's no pressure, and it's to me, it's a learning process. It's not a trade alert service. There are better traders out there. I'm pretty sure the guy with 100 monitors before me is a better trader than I am. But the idea is to empower everybody else that doesn't have time to do whatever, and to on their schedule have a resource. Sunday homework is tough for me. My weekends are gone. At least Saturday nights are gone. So I sold my car. No, just kidding. No, seriously, I don't have a car right now. I bummed a car from my son. I live in Southern California, so I don't need to go anywhere. It's pretty fun there. So the group is growing, and I encourage you to join a group, because you will make fewer mistakes. You'll be better for it. And I'm going to ask for questions right now. And every time I open up questions, I should tell you, I've done presentations online. This is my first in person. So thank you. Thanks. Yeah. Okay, so you think I would have a slide with a sales pitch on it? I don't. I'll be here all day, so I'll get you the information. The Benzinga team is around the corner. I'm pretty sure they have a place where they can take your money for it. So the group is fun, and so far they've been pretty solid. We've been doing it. I've been working with them off and on since 2011. I'm pretty sure. I used to contribute on Twitter, and then somebody said, "Hey, what you do nobody does on Benzinga. You should go check them out." So they threw my name in there, and I'm still working with them on one level or another. So we do something right. Otherwise, we wouldn't be there. And they will back it up with money back guarantee. So if it's not for you, if it's not a good fit, no, the risk is not there. There's no risk. And the pace is as fast as you want it to be. You pop in, you say, "Hey, what's up? What I missed?" And then you go. I have a guy in there I call Casper. He's been with me, I don't know, 8 years maybe. He jumps in. "I just did this." Then it's gone. And then he comes in. He asks, "What's the trade? What do you think of this?" And then he's gone. And he brings his own ideas. He got the point. He comes in. "What do you think of this setup? This setup? This setup?" And "Okay, thanks." And then he leaves. He comes back and tells me about it. So don't be shy about finding a ticker and just working it to death. There's a guy with me. His name is Jake. He's not here. Otherwise, I wouldn't say his name. Oh wait, this is on camera. Damn. Okay. So anyway, Jake's been with me for about 9 years. He's a little bit ADD like myself, and I find it hard to concentrate. If you give me a big paragraph to read, my mind shuts down. And then, but he was hard to teach. But now he just pinged me last week that he's 6 figures already just trading the SPX this year, and selling credit spreads, if you know what those are. That's it, SPX. Selling credit put spreads when markets fall, and then marrying them up with credit call spreads when they bounce. What do you need when you do that? Absolutely nothing. You need nothing to happen. That's how you make your money. How much? 12 to 25%. And it's boring as hell, but that is how you create income with option spreads. I had a product called that. So it is, find a niche that works for you. Don't chase whatever's hot. So if you hear about this stock and that stock, if that's not your gig, forget about it. Somebody said, what do you do with Upstart? 2 things. You either plug your nose and buy it, or you acknowledge that it doesn't exist, because you can't do anything in between. It's crazy. So if it's crazy, you don't have to trade it. The SPX is the market, so if you trade the SPX or the SPY, or the less known XSP, which is a baby SPX, which trades just like the SPX, what's the advantage? It's cash settled. So if you know what that means, if you don't ask, let me know. I'll let you know. But it's got advantages, so there's no assignment issues. And if you have a small account, that means that the broker is not going to close your position Friday at expiration before the day ends. They're not worried about assignment. So that's the little baby SPX, XSP. Also, the options on the S&P now are almost every day. I think they're going every day this month. So there's going to be expiration every day. Fasten your seatbelts. Go and get bumpy. So volatility is here, and volatility is going to be here for a while. So you have to be humble with your opinions if you're just trading normal. Questions? Yeah. Okay, so I don't have a thing for delta, so you're going to have to visualize it. So if you don't know options, it's a table, and it has 2 sides, because options come in 2 flavors. You got vanilla, calls, and then chocolate, puts. Neither are bearish or bullish. They're both. It depends on what you do with them. So people have this preconceived notion in their mind that puts are bearish. They're not really. I'll give you an example. Because not everybody knows options, how about we define options a little bit. So what the hell is a put? So the put is if you own Apple shares. So anybody own Apple shares? Okay. So if you own Apple shares and you're going on vacation, or you're worried about this month, some big crop's going to happen this month. So you can buy insurance with the options. So you go out and you buy a put. That's a contract. So calls and puts are contracts. No different than any other contract. So they have terms and conditions. The one term is time. So when you buy a put, how much you can buy it for 1 week, 2 weeks, 3 weeks, month, a year. You can buy it out to 2 years from now. It'd be expensive, don't do that, but you could. So that time is one. And then the second one is price. Where do you want to, how much money do you want to get paid for your shares? Like when you insure your car, 100,000 or whatever. That's what. So you choose a price. You're okay with Apple falling to 130, and after that you want off. So somebody will give you that guarantee. The other side of your put, the seller of the put. So you're both bullish Apple. You're bullish enough to want to keep the shares. You're spending money to keep your shares. If you didn't want it, if you're bearish, you would get rid of it. You wouldn't try to insure it, right? So you're bullish. The other person is bullish. They want your shares. So you're both are bullish. So everybody's happy. They get the opportunity to buy your shares. What if they don't? They keep the money you paid them. So selling a put, giving you the insurance, give them reward for wanting to own shares. So the worst case scenario is they end up owning shares at the price they want and they keep the money, or they don't get the shares and they keep money out of thin air. So it's a good symbiotic situation. What was your question again? I forgot. Oh, delta. Okay, the delta. Okay. So there's another way to use options, which is the call side. So this was the put side. So the chocolate side, or whatever I call it, vanilla side, is similar. It's a contract. I buy it. It gives me the right to do something. When you bought yours, it gives you the right to sell your Apple shares. What if I want Apple shares? I buy a call that gives me the right to buy Apple shares at a certain price for a certain period of time. And if I don't want to own shares, I don't have to own them. I don't need to own shares to do anything in options. So if I don't want to own shares, I buy the call, and if price rises like I thought it would, I can just sell that call for more money than I paid for it. So that's what he's asking is, what level do I buy? Do I buy at current price or do I buy higher? So if I buy higher, my chances of me being right are less, because if I buy a $200 call in 30 days, it's not going to happen. Right? Apple would need to invent a flying car. So where do I buy it? 150, 160, 170? The higher I go, the lower that delta number goes. And he's asking, what number do I choose? I like early 30s. So to give you an idea, the 0.5, what was Apple Friday? 150, 45? Okay, 147. So if it's at 147 and I buy the 147 call, my delta is 50, 0.5, 50, 50, coin flip. Just like you buying shares. The buyer and the seller of that call are at even odds. Nobody has an advantage. So if I go up, my delta drops. The price of the contract I buy is cheaper because I'm now having a smaller number. My odds are dropping. So my sweet spot is 0.35-ish. That gives me 2-3 bad days before my delta drops to the teens. And then I'm like, please, that's where you should get out. This is how I manage my odds, literally. I take the bet, I had the 0.35, 35% chance, roughly, that's a good gauge. And then price drops, and that 0.35 price drops away from my bet. And then suddenly I'm like in 0.2, and then, whoa, okay, so it's too low for me, my personal preference, so I get out. Somebody else might stay in it. Not me, but I have before, but not by choice. The only reason I go deep in the money is to sell calls against it, shorter term. I'll give you an idea. I'm short Oxy, just to pick a bone with Mr. Buffett. So I bought a put way out in time, and I've been long Oxy short term. So I'm short Oxy long term by buying a put, and I'm selling puts against it every week. So I may end up making money on it, but I have 75 days, I think, left over on that. I trade whatever comes out. The weeklies and the monthlies are the same. They're not magical. I mean, you can go. I do trade weekly, but not necessarily the weeklies. So I don't want to take a position that dies this week, and if I'm busy, because something bad happens, then I'm forced to take the full loss right there, as opposed to have some time to manage through it. So that's why I exited my position yesterday, because it was in trouble, and I had 8 hours to fix it, and I knew I was going to be busy with presentations, so I exited early. I don't use automatic stops because I'm on it all day, but I would if I wasn't. So I do put alerts. So if I have a position in trouble, I lay like 3 or 4 alerts to the prices that would get me in trouble. DEFCON 3, DEFCON 2, DEFCON 1, oh, nuclear. So they're good, use them if you can. They're complicated. I think Thinkorswim has, like, you can do if-then statements. If this happens, then do this. It's pretty complicated. Anything? Anybody? Oh, yes. Okay, I'm looking at the time. So implied volatility. If the stock is reporting earnings, the option prices for that week are on steroids. Do not buy options in the weeks where there's an event. You will lose money either way, guaranteed. I did a video on Roku and it reported. And I said, which way you guys want to guess? Because it's a guess on earnings. If you don't believe me, we can chat about it. I have proof. The bet was up. We were going to bet up. I looked at the options. I said, I think up is a better move. So we bought calls, but I looked at the options. The options were priced for the week of expiration 3 times more expensive than regular prices. So I said, let's go out in time, buy regular priced options, and let's sell the ones everybody's buying now at a higher price. The trade doubled the next morning at the open. As soon as it opened, regardless of the price move, the price could have fallen and we'd have still made money, because that's how expensive those options were. So we sold something super expensive, and we bought something normally priced. So we paid something. The next morning, they both died a little bit. This one barely died. This one collapsed. So the stuff we sold lost faster than the stuff we won. And we ended up with, if it cost us 60 cents to open the trade per contract, the next day it was like $1.10. So if you paid $600, you had double that the next morning. So that's implied volatility. It's important to look at it. Don't buy options. And if you must bet on that week, do a spread, because then you're buying something expensive and you're selling something expensive, then it neutralizes itself. But yeah, implied volatility, don't buy it. There was a stock that reported on Thursday, for the life of me, I can't remember. The implied volatility was 600%. I can't remember what it was. Who reported Thursday? Anybody? Yes. Good job. 600%. I said, I don't care. What do you think you know? There's no way you're going to make money off of that option. 600%. So the next day, even just from the open tick, everything in the options table gets down to 200% maybe. So you're going to lose all of the premium just from the open. That's hopium. Extreme. I think my time is up, right? No, 2 minutes. Questions? I see no advantage for the Iron Condor because you're doing 4 things. So the Iron Condor is a trade that has 4 things in it. Two things make up a bullish bet, 2 things make up a bearish bet, and you're saying the price is going to be between here and here. So that's a neutral trade. So it can go up and can go down as long as it stays inside the EV. So I don't see a big advantage with the Iron Condor. If you're selling a straddle, yes, but that's super risky, because you're selling 2 super expensive things. But with the Iron Condor, you're selling 2 expensive things and you're selling 2 expensive things. So that 600 doesn't play that much. The only thing it makes it maybe a little wider than normal. So if you really want to take advantage, I don't recommend you do it. You sell a strangle or a straddle, which means you sell a put and you sell a call, whenever sell calls, and the next morning, both are going to collapse. You buy them back. Yeah, so Iron Condors are good when nothing's happening. I love it. That's all I do. You need nothing to happen. You sell hope for the super bearish people, you sell hope for the super bullish people, and you hope nothing happens. And if you want to take it to the next level, I'll give you a hint and you can chase it. So figure out the straddle. So the straddle in options is basically gives you the idea of what market makers think of the price action. So market makers, it's not like there's an entity hiding behind the curtain. It's just whoever is selling to make a market. Like I have a pen, I sell it, I'm the market maker for that pen. So what they do is they're willing to take a risk and sell things to people. So if you look at any options table for the week and you see the call price, let's say $2, and the put price $2 at the same place. So if the market maker had their way, they would make sure that price is somewhere in the middle on Friday or expiration day. So then you know their sandbox is $4. So if price is at 140 of that stock, it's not going to go to too further than 136 or 144. So don't buy a put that's below 136, because for you to make money, you need the market maker to lose. You're not that good. I can tell you right now, nobody is. So, and when you're doing Iron Condors, sell outside of that $4. They'll work for you. The market makers work for you. So use the data of the market maker and play like them. Be a micro market maker. Think like one at least. So you've heard of Max Payne theory. They're on the right track. I don't think they do it right though. So, but they're on the right track. So their theory is look at the options, puts and calls, and you can tell where price wants to be. Like I said, they want to screw everybody. So basically they want to lose as much money for people as possible. So they tell you this is the line where there are the most puts and the most calls. I say it is okay, but that's a static number that updates only overnight. So what do you do on Friday when the option expires? You have that number as of yesterday, or what about today? So then you have to figure out, okay, if price is here and this is where it needs to go, what other orders came in throughout the day that this price has to go through? So what if it hurts the market maker more than getting there? So that Max Payne theory, I don't think it works as well as people think it is, but it sounds cool. Questions? If I had charts, I would take your charts. I love doing that stuff. I should have brought it. I said, do I need a laptop? They said no. What am I looking for? Yeah, so if I'm selling risk, if I'm selling a put, I want to sell below a lot of puts. So you see on CNBC, they say they're buying the blah, blah, blah call. Well, okay, so what am I supposed to do? What do they say when in options classes about options? They say most options expire worthless. So why do they go on TV and tell you where most options are? So you're supposed to go buy most options because everybody's going to win? So unless you're the person that's already there saying it, I'm not going to call people out, but unless you're already there saying it, I would love to take a position and go out and say, I think it's going there. You know, everybody piles in, it's like, I'm out. So it's pretty weird. But anyway, so what do I look for? I look for big positions. So if I'm selling risk, I want to hide behind big positions. So if I want to sell a put on that Apple, and I find a huge position in puts at 130, I'd sell at 125. There's a good chance it's going to be support, and my put doesn't get touched. Yeah, it depends on what I'm trying to do. But I'm rarely a buyer. I like to sell more than buy, but I do buy. I bought Twitter. So it was a coin flip, and it went up 30% until the next day. It went down 20%. So, but it was a coin flip bet on the arbitrage, and that's not my gig, but I did it anyway. So yeah, I like to use the options information for sure. I wouldn't do anything without it. And that, you should study options, how to read the table, and think about it's. Make up your own mind. The books out there are wrong. I read, and I think they try to sell you contradiction. So you're going to have to use logic. And the simple logic is, most people are going to lose money. So see where price is going to go to cause most of these positions to go to zero. Am I done?
Unless we have any other questions.
Okay, I'm good. I'll take questions if there are any, because not everybody here knows options. They're probably getting bored. Non-options questions, chart questions.
Talk about a workshop.
A what?
It's at a workshop. This is, we started out with a presentation, and I feel like we're in class.
Oh, you like a workshop class thing?
Yeah, this is awesome. Anybody else got questions?
Okay. All right, so on charts, you should expand your time frames on charts. Know what chart you're looking at. So if your idea is long-term, okay, you can look at a long-term chart. But if your idea is more for the next couple of weeks, you should start with a long-term chart, and then you should drill down a little closer, a little closer. So in the live room, I go down to 15-second charts, but that's not what everybody needs. And if I have an active trade, I usually have 15-second, 30-second, minute, and 5 minutes, but that's not what everybody needs. But if I'm trading, say, for 2-3 weeks, I should look at 30-minute charts. They're very helpful because they show you good enough information and it's granular enough without being too wonky with the data. So dare to go into charts. So I don't know what platforms you use. Most of them offer different times. So ask yourself, what can I learn from this chart? Things I use for charting, eyeballs for sure, for levels, that's supreme. Levels are my #1 thing. And then the patterns, if I see a breakout or a breakdown, to try to guess how far. That's how I planned. So now the 10-year yield is at 3, right? Weeks ago, I did a video. I said it's going to 2.9. I said 2.85 because of charting. It broke out on a weekly basis, and I said, if this is real, this is going there, and the market's not going to like it. And it's logged. It's on record, and that's what happened. I was hoping it wouldn't happen, but Mr. Powell flapped his lips way too many times, and he didn't learn his lesson in 2018. He's repeating the same mistake. So I would not be surprised to see him cut rates in December or January again, because they're breaking the country. So charts gave me the breakout. Patterns gave me the estimate of where it's going, and then you do with it what you want. So what would you do? You go long rates, you short the TLT somehow, you short the market, or you start building a bearish position. So levels first, the breakout. Second, the pattern that gave me the distance that it could travel. I did that same thing for Bitcoin, from 46. I thought 44 was an important line to hold, 44, 42, and I said if it loses it, I think it goes down to 20 in 3 steps. It goes down just below that, tries to recover, fails, loses the support, it just bounces off of, does the same thing, which it's doing now. So if Bitcoin doesn't go back above 30, by the way, it should go to 34 in the next couple of days. And then if it fails, like at 48, don't be surprised to see it 20 or 19. It's not a bad thing. Don't make fun of it. Find an opportunity. Okay, so here's my beef. Let's pick on Mr. Buffett, or Munger, I should say. Bitcoin, whether we believe in it or not, crypto, it's the best performing asset by far 10 years running. I mean, if they're in the business of investing and they choose to not play with the biggest win in their field, I find that very surprising. They're being staunch about it. I mean, they're super smart. Kudos. I mean, there's no way I'm in the same league, but I don't know how they see this. This is the best performing asset. Nothing gave you returns like these guys. Even Dogecoin. And yes, I bought Doge yesterday. It was like 7 cents. Of course I'm going to buy it. So we'll see what happens. So the patterns play out regardless of opinion. I found them to be agnostic fundamentals, but I don't do strictly charts. I don't do anything without charts, but I don't do strictly charts. I think a good blend of both is good. So if you don't have charting abilities, you should get help in that department. And they make package deals where there's software, I think they're here around the corner that actually does that. I think TrendSpider is here. They have TrendSpider, I don't know them. Hey TrendSpider, can you get me a free subscription? Your competition does. TrendSpider. I haven't used it, but I saw what they offer, which is automatic scanning for patterns. So if you don't know where to look for patterns, they might offer it to you. So I need to go talk to them. Maybe they'll give me. What is it? CBS or X? Chevron. If I own share, naked calls? No, I would short it. No. Why? Okay, so let me see this. Those who did that in GameStop are bankrupt. Not lost money, they're bankrupt. I don't want to leave my finances in the hands of idiots out there. No, I wouldn't do it. I would do a credit call spread. What's wrong with that? Oh yeah. And buy 190 and buy a put if you want to be really aggressive. So you sell a call spread, you get money in, you spend some money to buy a put, and you wait. If you're right about it being bearish, you're going to make a lot of money. If you think it's going to fall. Yeah, so I short it with free money is what I'm doing. If I sell a call, I get money, I buy a put, I'm short the stock for free. If it rallies, I lose some money. If it drops, I make a lot of money, but nothing out of pocket. It depends on how bearish you are. If you're bearish for 6 months, you buy it just under, or you buy it way lower if you think it's going to crash. So it depends on what your thoughts are. I sell naked puts, but I don't sell naked calls. Because naked puts, that means the worst case scenario, I buy a good stock. Huh? Oh yeah? You sold at the wrong time. Oh, ouch. Yeah. Yeah, that's a special situation. Yes. I sell puts in stocks I know inside out, and I sell it at places where I know they have support and support below support. So I don't take undue risk. I'm patient. Luckily, I don't need the money right away, so I'm sitting until I see something strong. Worst case scenario, I buy a stock I like. For example, if I sold the gentleman over there Apple puts at 130, so he gets out and gets protection at 130. My worst case scenario is I'm breaking even at 126. That's a problem I live with. Where is it now? Yes. Yes, confidently. I have no issues. Depends. I would avoid earnings. We saw what happened with Netflix. I would avoid earnings. By the way, on earnings, if you want proof that it's not about the results, okay, I'll give you a couple of scenarios. Sorry about that. I'll give you a couple of scenarios. One, Apple. Anybody remember when was the last crappy report on Apple? Yeah, no, right? 1 out of the last 6 reactions was positive. So if it's about results, how is that possible? It's not about results. It's about expectations, how people feel. Like, I know what I feel. How many people like me? How many people like you? How many people? And it's not about the actual results. It's about expectations. And I'm not talking these stupid estimates, analyst estimates. It kills me when they're reporting on Upstart. They missed earnings estimates. Wait, that's a growth company. What the hell are you looking at their earnings? People shorted Amazon for decades because of its earnings. Well, they were changing the world. You can't pinch pennies and change the world. You look at their price to sales. You see if they're growing sales. What? Okay, I'm good. I'm just answering questions.
For the brilliance of Nick Chahine. Thank you, sir. Before everybody leaves, one sec, real quick. If you enjoyed this, go on Twitter at Racer, N-I-C, at Racer Nick is how you can follow this man and continue to learn on the way out. One more thing. We did this yesterday. I want to do it again real quick before we go to break here. I found this to be very fun yesterday, but real quick, my name is Wolf, and if anybody has any problems with what's going on today, I'm here to make your experience great, so just coming up and say hi. Before we go, we're going to do a quick blood-flowing stretch. Everybody stand up real quick. Don't worry, you're not going to have to sit back down because you're going to head out after this for a quick break. Before you go out, do it with me. We did these yesterday. Hands up. And some forward arm mills. Do 5 with me. There we go. All right, 5 backwards. And we're just going to do one more thing here. We're going to take our arms. We're going to go across. Out. Don't forget, the bounce is critical. All right, the bounce is critical. And we're going to go the other way. And then we're just going to take our hands up one more time. And we're just going to fall forward. And we're good. All right, come back at 11:25. We will have Leif, the 2019 U.S. Investing Champion, on stage. Don't miss it, 11:25. See y'all soon. Enjoy your break. champion. Let's welcome him to the stage.
Thanks, guys. Okay. Is the mic on? Okay, here we go.
Yes, sir.
All right, here we are. So usually I do this like on the internet, and I have a webcam above me, so it's probably a surprise to everybody that I'm 6'6". I'm usually pretty short there, right on the screen. So that's the biggest thing I'm getting in so far. But we're gonna do this presentation. Risk happens fast. First of all, thanks for having me, Benzinga, Jonah Lupton. It was great to meet a lot of my members, of course, and we have some here today. And originally I was set for Friday, so we switched it to Saturday, and I had a member fly in just to see me on Friday. That meant a lot to me. She flew out right after seeing me at cocktail hour, so that was great. And a little bit about myself. I'm an MBA in finance, serial entrepreneur, U.S. investing champion, founder of Champion Team Trading. So, I just love swing trading. So I do this all the time. It's, I rarely get a break. I'm always looking through charts and trying to improve the methods and stuff like that and teach it. So one of the funny things about my positions right now is I'm actually short MGM. So they own the ARIA. So sorry, don't cut my mic. Don't do it. I swear I'll cover soon and we'll get over it. But we'll show a slide on that too, which is kind of fun later. We'll get into some good stuff. I'm kind of like, I think of myself as a very aggressive breakout swing trader. Absolutely love it. William O'Neill's kind of the primary inspiration, the overall style. And more, and I'm inspired also by, Minervini, Dan Zanger, other trend followers like Weinstein, and on and on and on. So, and we're in person, so come see me after. We'll make some memories, talk a little bit. Let's see what else we got here. And we're going to go to lunch, so come meet me there, I guess, and we'll see what happens. So, Peloton. This is kind of like Luna Coin, right? So this is, risk happens really fast, but this is, what is this, a monthly chart or something? But I think this went to $12, okay? So the more I follow kind of long-term growth investors, the more I notice them, the best of them kind of evolve into swing traders, or at least putting some rules down. So we don't want to give back these kind of gains. This is when things are really easy and then they get difficult and they roll over, and you got to have some kind of sell discipline. Otherwise, you end up in Luna Coin, right? Just because it's crypto doesn't mean you shouldn't risk manage. It's all risk assets. So, that's the main thing that I started doing. The more my account grew, the more I couldn't afford to give it all back, because I'm not going back to, start over. That's the main thing. So, let's see. Yeah, in a bear market, he who loses the least wins. So, because you don't want to give back all this action you got if you're trading something like this. You want to take this and compound it into other winners and new IPOs. We've got the life cycle trade people here. I just saw. How you doing? Read that book, by the way. It's a great book. Trading is simple, but it's not easy. And it's a lot of work to do the work, to do the risk management. A lot of stocks check back, and 80% of the stocks drop 50% during a bear market. That's like an O'Neill stat. Capital gains don't belong to the house, like in Vegas. You don't want to gamble those. And some of these stocks just never come back, no matter how great they are. And this, Peloton, as much as you like the bike or whatever, there's always another bike around the corner, right? Maybe, So it's the same thing with any other app payment system. Square, PayPal. What did Larry Ellison say once? His cat wrote one of these programs or something. So you got to be careful to not fall in love with one of these stocks. So. Risk management, and this is some of the basics. We're going to get into some better stuff later, trust me, so bear with me here. Okay, so this is when I won the USIC. In the beginning of the year, I was up right away like 15% in the first month, and I said, I'm definitely going to win this. And then all year it got real choppy, but it set up enough with the breadth to make some decent bases, so that by come October, kind of the stocks above the 200-day moving average, and they kind of went together with the price of the index, and then that's kind of the best environments when they move together. And that's when you can attack, heavily, get heavily invested, and if you're having trouble in the medium term, you got to be smaller. So it's just a little clue about when I won that. So the other thing is divergence. You got to be careful when you get these negative divergences. You got on this slide, you're seeing the price rise into these sell-offs, but before the sell-offs, you have breadth deteriorating, the stock's above the 200-day moving average and the NASDAQ, they start falling apart. Then you start having these slimmer environments, and there's just less stocks to choose from, and you get sucked in by, say, NVIDIA or one of these larger caps that are kind of holding up the index. And you say, oh, well, I should have bought Tesla, that rip, but basically everything else is kind of rolling over under the surface, as you can see. And then you have, eventually, the index catches up to the kind of the health of the market like that. So, all right, so we're going to get into my process. Obviously, it's pre-trade, risk on, post-trade. We're going to think about all this stuff. These are the 3 sections, okay? So some of the basics, then we're going to get on to the good stuff, okay? So the pre-trade, preparation for tomorrow's trading session begins at today's close, okay? But not today because we're in Vegas, so make sure that's Monday or Sunday night. The more you work, the more work you put in, the less thinking you're going to have to do at the open. So that's important. It's got to be a little more automatic than you would think. So it's basically impossible to know what will happen. So you have to be prepared for all different scenarios so you can execute it correctly, okay? So you can't control what the market will do on any day, of course, but the more time you put in, the luckier you're going to get. So it's not about being lucky. It's about putting the time in. Trading is like solving a puzzle. You got to put all the pieces together, look at all the indicators, look at the stocks, and primarily the stocks are my key indicator to see what's setting up. And if lots of stocks are setting up, if they're not, forget it. So I do 3 simple categories, red, green, yellow, with some basic kind of suggestion rules here, right? So if I'm on green, I'm 50% or more invested, risk-seeking, slower to move the stop, slower to take profit scales. But you know, ideally, I want to be all the way on margin, so we have to get to that level somehow. You know, yellow signal is a little more selective, and you can do a combination of both, kind of like at different tops. You can use more tight risk management and kind of switch those around. So when things are tricky, you got to stay on what I call red signal, and you're quicker to take some profits and take some off the table and move your stops to even. So, okay, so let's get the next slide here. Yeah, the universe breadth, I kind of went over this a little bit already, but define your universe, okay? So the number of stocks and kind of in the uptrend is key. I mean, I want to trade small caps and mid caps because, you know, when those are set up, you can really get those quick pops and sell those into strength and kind of flip in and out of them. So you got to define a universe and say, you know, I'm not going to trade utility stocks or something like that because those are slow moving and boring. Track the number of stocks in your uptrend. Okay, you got to define your what you think is an uptrend, and you know all the moving averages, you know, sloping up together. That's definitely the key, and you want to have those stocks, count them, and when the counts are improving, that's the overall breadth is improving, and you know you can do this in. Market Smith has these the Minervini trend templates. If you have that, the 1 and 5 month, you keep count of those, and that's kind of easy to keep on a spreadsheet. Just make a note, and you can see if they're going up or down. The percentage of stocks in the NASDAQ over the 200-day moving average, see if that percentage is changing or declining or rising. So, okay, so sentiment is another thing. Let's get into this. Name exposure. In a nutshell, I mean, basically this shows like who's left to buy or sell. Okay, so if everybody's invested, you know, you're possibly at a top. Okay, because you have to have someone else buying the stocks to kind of bid them up. You know, and at the lows, if no one's invested, there's no one left to sell, maybe. It's kind of the basic thing to think about. So these are kind of contrarian indicators, and these are reported each week. So and it's the name exposure index. So this relative strength chart here kind of shows large cap growth versus value. And sometimes you can switch into large cap growth, like you know, in 2020, that was kind of the first to start moving there. It kind of is a signal when you start having the ratio improve to the growth side. You're in a good environment. When it's kind of going upper left to lower right like it is now, you're having a pretty lousy growth environment. You don't want to be involved with that too heavily. You're going to be in select groups, select stocks. So, okay. And let's see. Okay. So recent trades. So this isn't my equity curve, but this is something to think about. It's from TraderSync actually. You know, I pay attention to recent feedback on your profit and loss. I mean, you see how you're doing. See, you know, is your profit and loss, is it increasing? And then that's when you're pressing it, you know, and you got to be careful not to press too hard and be too late about it also, because sometimes on big moves, you know, people wait for too much confirmation and then they buy and then they get sold to. So you kind of want to think about some stuff like that. You want to see if you're getting traction or not, if your stops are getting hit. You know, if you're out of sync with the market, you got to dial it back. I mean, you can see on that chart in the beginning, that looks like an equity curve that's kind of out of sync with the market. And then as it starts to, you know, starts to rise, they start to press into some kind of a strength, but then it kind of rolled over, and then that's when you should, you know, fully press it when you have that sweet curve up in the, you know, at the end of that one there. So, at the end of the 2020 run, I was noting that I was on green signal sizing, but towards the end of the run, you can kind of use tighter risk management because you don't want to give it all back. I mean, that's kind of one of the most important things. And great runs don't last forever, so you know you don't want to press right into the top of that. So, all right. So let's talk about some scanning. Okay. When you define the market's condition, the next step in my process is scanning and reviewing the charts, obviously. And you know, the most important thing is to find a leader. If you're not finding a leader and you're just finding some a pattern, you know, and just because you found it in a textbook, a lot of these things, the average daily range of the stocks are slow. You got to focus on leaders that move fast if you want to make some real big money in the market. So that's one of the things to look for. You got to have the sound bases, of course. Let's see. You want to look for industry groups that have been rather weak, but there's several stocks setting up great buy points. And then, you know, when there's a turn, if there is a turn, you want to be in those stocks that are setting up. And, you know, this kind of recently happened in March. Some biotech names, I think it was VRTX and REGN, it's off the top of my head. They were kind of setting up when we were very oversold condition. And as soon as you turn, you know, 1% on the market, those are breaking out. So timing is also important. So, you know, have the recent breakouts acted? You know, how's the group? You know, what are the buy points that look right? So it's not about just buying the patterns. Like, what patterns are working currently? That's kind of something that most people don't track. So, you know, I look for, I'm going to get into pivot resets, but I start counting those. Say, okay, that one worked. How many days was it? And then you start to kind of track like an average of what's working and have like a picture of kind of how the money's moving in and out of these stocks. Lastly, I kind of avoid opening positions too close to earnings, you know, like 3 days or less, because a lot of these patterns are created by earnings. So you're basically assuming you're going to get some kind of a pop when the pattern is probably created by earnings, people waiting for confirmation to see what happens. So, you know, there's no reason to drive yourself crazy and get, you know, too many right into earnings, and it's just a gamble then at that point. It's a coin flip. Sometimes the earnings they look good and they sell off, and sometimes they look bad and they buy it, so you just never know. Okay, so the 5 chart patterns that I primarily trade are high tight flags. And everybody thinks I got this question a lot. Do you only trade high tight flags? Well, no, because I mean there'd be no trading for most of the year, really. So I mean, you're waiting. These are rare patterns. So when you finally get them working, then I'll press them pretty seriously. Right now, there's a few that are setting up in, you know, coal and oxy, and I've traded those for a few dollars. But you know, we'll get into that. But you know, there's nothing new about a lot of these stocks. There's no N in Can Slim in those, and I'll show that. But yeah, the rocket base and all this, we're gonna get to that. But mostly like cup and handle VCP type of action, we're looking for that within these types of setups here. And the main characteristic that I look for is a declining average true range, and it's called ATR. And declining ATR is a sign of kind of price acceptance. Things are getting quiet throughout the base, moving into the right side of the base and towards your buy point. Most great patterns have this characteristic. You know, after the breakout, the ATR will rise, and I don't use it anymore. I'm just trying to capture that buy point perfectly. Yeah, definitely tight price range is what you want on your bases. You want that RS line increasing into your breakout point. That's absolutely necessary. I mean, you got to see that versus the S&P. Look for that on the right side of the base. Okay, so we're going to go into the high tight flags, and this is what everybody loves. So this one, I mean, I'm going to look at this one. This is very aggressive. It's kind of funny because, you know, we could trade those, you know, 2020 and the beginning of 2021. These worked, but the tightness on the right side was terrible, but these patterns were working at the time. And these are 100% moves in a few days. So That was the funny money time, and that was a lot of fun. As you see, I'll get one of those. Yeah, so you get up there, you get 100% move. That tends to slow things down. A lot of people will sell into that. So let's see some other ones here. So this is AMR. Recently, we're kind of in this rare environment where all these commodity stocks are setting up high tight flags. And, they tend to throw back a lot more. I think buyers are a little unsure of, is this going to go another 100% or not? So you're going to get a lot of check back on these. And you got to buy them right, though. And these do have the tightness throughout and the right buy points, but they check back. And let's see. So CTIC is one that everybody was watching recently. And I don't trade anything under $5. So I kind of passed on this one. Kind of no earnings biotech. Threw back to the buy point, and it's kind of difficult environment for that when it's basically a risk-off environment and you have stocks imploding everywhere. But these live in their own universe and they can work even in bear markets. But you have to know when they're working and be honest about it, not just attack these all the time. So yeah, FLGT, another one of these kind of aggressive buy points there. LNTH, this is kind of a recent one. Bought that, sold some into strength there to see if it would keep, it could keep going, of course, and sold off into earnings. And I think it's already back to the buy point again. So this type of environment we're in, you got to recognize that. And when you don't have any cushion going into earnings, it's just a gamble. You might as well just buy it right before earnings if you're going to do that. So, all right. So FUV, okay, so we're going to go when to sell. Some sell notes on these charts. I mean, this is the 100% move. It's an old trend following trick is to kind of sell when you make it 100%. So that's why I think high tight flags require that 100% move. So you'll have a fund and they say, well, I made 100% from where I bought it, say the 200-day moving average or something. And now you have your high tight flag because they just sold it and stopped the price from going higher. Now it can kind of digest and you have your next buy point, or it fails like this. And this is just, I remember trading this one and I actually sold it very close to the peak. You're not going to get a lot of that, so don't think that's going to happen every time. And I sold some along the way, of course, but I think this is a 5-person electric vehicle company or something. And that's back then you could trade those. So not anymore, but okay. So which one was this? So not high tight flags. So this is kind of important too. They get some of the technical measurements right, most traders, but you got to take in the big picture. And there's all kinds of little nuances in high tight flags that matter. So this one is, it's measured as a high tight flag from where it is and looks okay, but you want really new highs with no supply in the pole. You don't want 50% corrections in the pole. The pole is the rise from the low to the high. And some people will say you have to measure from the high of the prior base, or you can go slightly below. But if you have to argue too much about it, I probably want a little more time in the flag before I attack that. So if you take in the full picture, to me this is just a big base. So you got to look back a little farther, and you see there's plenty of supply there within the pole. So as that goes up there, you're going to have buyers looking to get out, and it's really just only a high handle to the overall cut base, in my view, and it's probably a steep decline and steep rise, and there's some power to it. But in this environment, that'll probably check back. So this one, I was watching this one next for a high tight flag setup. And as it drops out, it's still within range. So I call this a rocket base because, now you have your regular base instead of a high tight flag, just, from a kind of a powerful position. You just want to give it a little more time to kind of digest because this thing dropped out. There wasn't so much support as a high tight flag, which would stay 25% or less in the flag. And if this drops out a little bit more, I just want a little more time with it. So let that kind of, build out, tighten and break out. And in this environment, they got to be pretty perfect for me to go that way with it. So, okay, so scanning for high tight flags, there's a lot of different criteria you can use. You can email, Champion Team Trading, admin@championteamtrading.com if you want to get this. Basically, just a couple examples of what you can use here for, what your criteria is to, if you don't want to go below a certain market cap price, you can change these for yourself and use it on stock charts. I think that's free. I'm not sure. I pay for it, but you get size, get volume, trend filters. You want to see that rise, at least 60%. I mean, a real high tide flag is 90% plus, and so we're wanting to capture the early ones too. So we want to see that. We want to see the maybe 80% rise or something in a few weeks. So let's see. Okay. All right. So in relative strength, we obviously want to do that, but this uses the Scooter rating. Market Smith's RS rating. I like 90 plus. I like real winners that are strong, that are basing, and that focuses on the stock's performance over the last 12 months compared to the stocks in the Market Smith database. So you can kind of have your preference, and mine's 90 plus. So you're going to get the stronger action that way. And the number of results is an important indicator for however you're screening for yourself. You can just track this and not anything else. If you're screening and you take away the high tide flag criteria, do your own screening, see what's setting up for your universe, and see if that number is increasing or decreasing as you're going. All right. So this is a little more detail on the rocket base. This is kind of a bunch of power. This is right below the 50-day moving average, so it's not really buy point there. But what I'm looking for is like about 6 to 10 weeks on a real powerful move. I want some digestion. I want the stock to kind of base and spread out, and look for that buy point, cup and handle, VCP action, something like that. And I want to prefer these because of the power behind it. I'm not trying to rebrand O'Neal stuff or anything. I'm just, I get frustrated with a high tide flag that fails. So, this is something that I'll switch to this. You have to give it more time after to get any success with something like that, though. So, one of the things that I really like is earnings pivots. So we're looking for entries at a viable pivot or pullback as earnings are reported. And like I was saying, earnings create these patterns. They create VCPs. They create cup and handles. It's a lot of buyers waiting for confirmation before they push it to the next phase. That's the thinking behind it. That's why I don't want to jump in right before earnings and end up down 20%, at the open. I'd rather wait for some confirmation. This one actually opened, kind of checked underneath the prior bar and turned up, and that would be the buy point on this one. And this one fizzled out, but it's just a recent example. I didn't trade it, but we're looking at this. I didn't take this because I made a mistake myself. I was looking at this in the pre-market. It looked like it was opening at $22. So I just said, forget it, and I looked at something else. And then this thing, took off pretty nicely, so, and allowed a buy point, so. Okay, so OLN, this is one I've traded several times, actually. This one has a nice big base, and, as it gets to the end there, I'm a little bit ahead of earnings, as much as I'm comfortable with, and it's trying to see if I can get some kind of pop out of it and some cushion, but I didn't really have any, too much cushion, so I made it profitable, got out, waited for that earnings confirmation, and as it turned up, to me, it's like, okay, everyone in this base accepted this price, and earnings looked okay, so now, you're going to the upside potentially with the coin flip, but, as the price starts moving up, it's just telling me that's where it's going. So we're aggressively buying this a little bit high, and then we're selling the whole thing into strength up there right away, So in a kind of negative environment like we're in now, we have earnings pivots going to the downside. This is the other thing that people probably don't think about too much because everyone's swing traded the long side. But I've been showing a lot of these lately and wait for earnings in a roll. So this is MGM. It's kind of funny that they own the ARIA, so I just thought I'd put this on and actually short this stock. But in the right here we had, let's see if I can do this. This is the other, I think this is the other earnings with the breakout watch. So I'll take it long or short. It's nothing personal against the stock. And then, we'll cover this and hopefully, I'm sure this will resume its uptrend at some point. I think the numbers were quite good, but this, earnings came out and it rolled below the moving average. So it just didn't seem like there was enough juice there after earnings and, for people to bid this up. So that's the short. Same thing with MP. This is a recent one and I shorted this and I've already covered both of them, some of them, but not all of it. And this one, reported earnings, opens, slightly inside the other candle and rolls over. So this is one that I shorted too, because you can get a fast mover to the downside in a real negative environment. You can have some luck with that. And earnings kind of clarifies things, and they didn't like it after earnings, so it might go much lower. You never know. But we're having these really big bounces right now, so shorts you got to be a little bit quicker with. And if you're not quick, the 4% rally we had yesterday in the NASDAQ kind of put you out of business if you kind of short into the hole. So you got to time the market with these a little bit better too. So But I'll do a high RS and long base, but I'll drop down into the 80s too for longer bases. I think it's AVGO, right? Which one is this? Yeah, AVGO. Yeah, so this one's a nice long base, set up pretty well at the end there. Kind of has a little cheat or pivot at the end. We have that RS divergence and pretty standard buy actually. There's really nothing to it. It's just trying to buy a potential leader. This is setting up for its next move higher. So that would be a buy point there. And so the pullback buys. So pullback buys are kind of interesting. They're best entered at the conclusion of the base of the breakout or near it, kind of on top of supply, on top of the base, where the prior trading was rather. And I want to see kind of light volume at the lows. And I like to kind of fish lows in the cup and handle, right? So you get in the lows in the handle there. This is a little bit of a sloppy handle. It's not my favorite look, but you get the idea. It's kind of pulled back, light volume on the low, and then turned up, and then just selling it into strength as it kind of turned up there. As that group was very strong, this one just had a light pullback because you got a little too excited, a little too V-shaped off the low. So kind of V-shaped moves and bases, just this little off the top of my head. Just they're kind of failure prone within bases. Take a look at the last moves in like Apple, Tesla. This reminds me of that kind of quick move up the right side of the base. Those will tend to check back. So when you see that, that's another trick to kind of consider anyway, or a method. So here's another type of pullback. It's almost like a pivot and a pullback together. Is you pull back on moving average, tighten up, and then kind of turn up on some volume there. In some kind of quasi high tight flag measurements there. So. And pullbacks, they take a little guesswork, and they don't really act like breakouts, okay? So like pullbacks, as they kind of round out, everyone expects them to just kind of like rip like a great breakout, but the timing, those kind of round out, it's a little more smooth, okay? So that's just the way I look at those, and same with kind of like taking it short. They tend to drop out eventually if it's a good short, but you shouldn't expect too much too quickly out of a pullback buy in either direction. All right, so let's get to, well, here's another pullback buy, right? So we had the low volume after the pullback. Just a few days within the pullback are ideal. In the average true range, it can be a little bit elevated because maybe your pullback buy is attempting to get out of the base. So you see a little bit of movement, some big bars. You just want to see the low volume on the pullback and the turn. And this is a little more of a aggressive buy, in a better environment. So that's a little pullback buy there. And I prefer them on top of the base, but this is kind of at the end of the base, not too much supply over it. So, all right. And pivot reset. Which one is this here? Okay, so pivot resets are kind of false breakouts. That reset basically. It's just, so I just call it pivot reset. So a lot of traders try a breakout and they're stopped out and they'll give up on it, but you don't want to give up on it if it sets up perfect. This is a little aggressive and a little extended on this Zim, but it's just a 5-day pivot reset. This one's a little more textbook, as you have traders trying for a move out of the low area there, and then it pulls back and sets up tight enough after a washout. So this is a little bit of the first mouse gets the trap, the stop, and the second mouse gets the cheese, the breakout, and that's kind of the thinking you have to have behind trying to get in a leader, a potential leader like that. So, yeah, risk on. So it's time to act. So this is your brain, and this is your brain after the opening bell. You're basically scrambled because basically anything can happen, but you have to be prepared for anything. You got to be present. You got to be alert and focused. Once you've done your homework, there's no reason to second guess yourself. In doubt just hinders your success, and use a little imagination at the buy points before. You got to do a little rehearsal. Say, okay, how's this going to act? And if it does this or that, low volume at the buy point, am I going to buy it? Have a little bit of mental rehearsal, I think, too. And learn when you're thinking negatively and try to refocus that energy. And you're not paid to sit in front of the screens all day, obviously. So, you got to wait for the right opportunities, and they always come. So, all right, when it's time to execute, don't expect to have any consistency in your results if you don't have any consistency in your execution. okay? So, you know, if you just trade because, you know, you have that time during the week on Tuesday afternoon, that's, you know, maybe a little bit not the right way to do it. You got to think about your execution. And everyone tends to overcomplicate things in an effort to know what will happen. Everybody wants to be right. So yeah, don't try to be smarter than your homework. That's a good rule. And you definitely don't get smarter after the opening bell. That's what homework's all about. So, you know, intuition comes from practice. So you must really believe in what you're doing. Just trying to keep things simple to avoid paralysis by analysis is key. Okay, so we want to see how the market's behaving at the open. Did a gap higher or lower? Any buyers present and in control? Okay, so that's key. You don't want to buy a breakout maybe with no volume in the market falling apart. Is this going to go against you perhaps? So that's just something to consider. You got to think about your industry groups. You know, which industry groups are outperforming? And are there any stocks on my watch list in these groups, right? So you should show up with the leaders in that group too, not just anything. A lot of people show up with the best pattern in the group, but it might be the worst stock, you know, low liquidity and not a fast mover. Unless something changed with the stock, you know, that's key. So which stocks on your watch list are experiencing, you know, high relative volume? That's what you want to see. And relative volume is that intraday ratio between the current volume and the 3-month average. At least on FinViz, it's one to use. And I use TC2000 also. You can check that out. And you know, you can use all kinds of other indicators that update throughout the day. And I'll show a few of those too. So, you know, light volume tends to lead to a lack of follow-through in directional moves. So it's all about execution. And of the stocks on the watch list, they're experiencing the highest relative volume, which are most likely to have already traded the day's low. Okay, so when picking between multiple stocks, I favor those where the day's open is equal to the day's low. So you want them opening and the price pushing up off the low. This is kind of a thing not a lot of people think about, but that really shows the buyers are in control when your candlestick opens on the low and then just kind of rises throughout the day and through the buy point. And that's something that we use a lot. And that's actually an indicator that I have on this TC2000 that I give the members. So you can see that updated in real time on a spreadsheet, which is really nice with your watch list. And with all your trend criteria stocks just set up automatically. So yeah, FinViz is a good one too, but you know, the prep should be so good that your Vegas hangover doesn't affect your trading. So you should be able to execute. You just got to be ready. So, all right. So this is the Marubozu candle. I don't know if I can say that right, but this is what I'm talking about. When the candle opens on the low and closes on the high, this means you did your job correctly for the day. Basically, if you got this one right, you probably want to sell a little bit, which I did on this, and eventually this rolled over. And this is whipping all over the place now, but. Making the trades lightly profitable on a red signal are kind of key, but you want to see that open on the low at the buy point and then press higher through the buy point, or right at the buy point is fine too. So within range of about 1% or so. Crypto traders might call this the moon candle. Is this what you want to see? I mean, it's not that big, but you know, we've seen better ones, 2020 anyway. So you also want to see that average true range. You want to see that coming in throughout the base, and you can see on this chart, you can see this average true range kind of coming in there right into the buy point. You have this low volume right there in a tight area. And then as I see the volume come in right off the open, I'm buying that. So, and you know, we're trying to get a move up there, but you know, not in this environment. They're checking back quite a bit. So you got to be faster with your profits, at least for the time being, you know, taking your profits. All right, so scaling and trailing. This approach that I have is a little bit of mix of art and science, okay? So, you know, the more risk you have on, the more difficult it becomes to make good risk management decisions, basically. So, you know, humans are wired to avoid stress and pain, which makes it difficult to think objectively while in a trade. You got to get comfortable being uncomfortable, and you really got to size up and be at your biggest right at the right buy point. If you want to really make any money, you got to get a lot of money in it. And I work on a lot of advanced ideas about trying to get in with size, you know, using staggered stops and taking some off into strength and taking that overweight off, or if it's going against you, you're taking that overweight off in the other direction, you know, in a small way. So you can take many staggered stops even to keep yourself in the trade, but not huge. And you can also see if it's a 1 minute candle or not. This where all the volume is. You want to see the volume kind of steady throughout the day. All right. So you got to manage your trade, not your feelings. Okay, you got to avoid being a victim of your emotions. The goal is definitely to reduce the need to think while under stress. I mean, it's a lot of stress, especially if you're up on a green signal and things start going against you and you're giving back some money. You're going to have a lot of stress. So you got to manage that and have those expectations. And this is also primarily a level of difficulty. And then, you could be more heavily invested on red signal if you're catching the right groups. Say you're on all the energies and the coals and all that. But you can also risk manage them very aggressively and still stay in the trade for a bigger move. So that's it's all a personal decision. I only just go over the methods and present to my members and everybody, some different ideas and what the situation is. Everyone has to use that for their own trading. So, and it's definitely not set in stone, and these things change as things get extended. You can, go from green to red while keeping your positions open and being on green size. So that just talks about where it's at. If you see that, we already went over that. So, I've been on red signal since April 4th, and then right before that, we had some traction in different industry groups that are we got to be very selective right now. As the market was very thin, as I was showing the divergence in the breadth and the price of the indices, and now that we roll over, you only have a few sectors that are holding up. So, all right, a little bit of trader math. Don't worry, there's no quiz when I'm done with this one, but the expectancy is the average win times the win rate minus the average loss times the loss rate. So this table provides a baseline for formulating a realistic trading strategy. It's a reality check for new traders who think trading provides a fast track for wealth. Okay, so it's possible to be profitable with a low win rate if your average winner is large enough. You can go down this table and you can see where that would be. For different levels, and this table assumes that trades are all the same size, of course, but my sizing will change based on the signal. And stats for different signals that makes sense too. So if you're on green signal and you see all the stuff working and that's your typical signal, what is your average winner then versus in general? Because if you just kind of lump all your trades together, it's not exactly talking to the current market conditions. And that goes to kind of looking back at past trades and stuff too. I always say, well, you go back and look at a chart and some breakout from 2 years ago, kind of like with no context, you're doing yourself a disservice. You're just looking at a textbook. You don't know what was going on at the time. You kind of have to rewind all the charts and the indices and what was the breadth then, and you got to kind of match it all up. If you want to study what happened in a certain time, get everything, all the indicators that you use that matter to you, and study that trade against those, indicators. You see how everything was acting, how was the group acting, how were the other groups acting, stuff like that. So it's not an exact science then, obviously, if you do it like that. So it's a little bit of a mixture. So okay, so when to sell? Seriously, guys, when do I sell? I have no idea. It's like this is one of the hardest things to do. Just kidding. I was hoping someone can answer that for me, but right now you don't ask too much of the current market conditions. So kind of like making a trade lightly profitable is key, sort of to take the stress down as you finally try one and you get something working. So then you can move on to other trades and see how much money you can actually get in the market, and see how many trades you can get on and push that equity curve up, but without giving it back. That's the red signal. You want to move your stops to even as fast as you can at certain risk multiples. Okay, so there's a lot of ways to do it. I mean, you can look for violations, technical violations. You can use moving averages. You can use the kind of 100% sell rule, which we're not really getting right now. It's unrealistic in this environment, but that's just kind of a fun chart there to take a look at. I think that was actually an actual trade too. So. And yeah, once again, I should go back to this. So you got to put yourself in the position of other traders. That's another way to think about it too. So if the 50-day moving average fails, most people are going to close it. So you're just going to, maybe you're going to have a big downtrend all of a sudden. So you got to get out, and then you're not having that first slide Peloton or a Luna coin or something like that. So, okay, so post-trade. And this is what I was talking about. Maybe I jumped ahead because I'd rather not read this and just talk, right? But this is, usually I live stream and we go on forever. Everybody brings up charts and we work off of that. But this is kind of talking to growth traders that hopefully get some more risk management. This is kind of why I want to put this together. But studying past trades and other trades in the book, like I said, you got to rewind all those programs and know what signal you were on, what was the giveaway that the trade was going to work. The context, it's definitely very important for the post-trade analysis. Is that Mario? What went wrong? Okay, so we definitely want to do less of what went wrong, of bad trades rather. Track your progress. Many good trades won't work. That doesn't mean you got to give up, change your style, change your plan, and start, just buying SPY calls every time something, goes a little lower or something like that. You just have to sit in cash or be short, obviously, but trading your system, whatever that's going to be. You got to accept your trade and look for the next trade while you're risk managing. Accept that loss too, and as you're taking losers, you're sizing down too. This is the most important thing people don't do. Kind of at the end of these runs, when like I was showing, the breadth kind of started, falling apart. You're not, okay, you might be taking some more trades because, like I was saying, NVIDIA and this kind of, Tesla might suck you in, or Apple could suck you in to the market and start trading again. But as those roll you out, you don't want to just go bigger and bigger to revenge trade. Then you're digging a hole, and your brokerage account's gonna look like this dumpster fire here. So I definitely don't want that. So you got to learn from your mistakes, and sometimes your mistakes are just, it's not what you did technically, what you're buying. It's more of how you're pressing it wrong. That's a real analysis error that most people make. They say, okay, well, those trades just didn't work, but in reality, you pressed too hard. That was the biggest problem with what went wrong in your trading. You were actually making good buys, but you're just looking at textbook patterns maybe, and kind of not thinking of the whole picture of your equity curve and the win rate of the stocks, and you kept pressing, thinking things were going to work. But you got to start counting bad trades and say, okay, even the ones you pass on, you have to monitor those. You see, okay, these are all failing. I don't want to get involved with all these failing trades, right? So definitely track what went wrong in a big way, and what went right. This is the other thing. So selling some into strength at several risk multiples is the main goal. And really, I'm a trend follower. I want to sell some into strength, but I want to catch bigger moves. And if it wants to trend, forever, and if I do sell that into some big rip like that, I'm still looking for another entry back in the stock, if it sets up again. But a lot of times, like I showed in 2020, a 5-person EV company worth billions of dollars is going to roll over. So you definitely have to, look for the next setup, or let it roll over without you. And a lot of times they roll over, and a lot of them is just, liquidity-driven events, and all that stuff starts flying. And hopefully that's happens soon, because that's what's fun to trade, those types of stocks. And what went right? So one of the things people do wrong is they're not big enough when things are working. You really got to press it hard to have those big returns, to win a contest, or really get those gains, that everyone's looking for, 100% plus on the year, stuff like that. You got to be huge, at the right time. A famous thing where Soros criticized Druckenmiller was he criticized him for not going big enough when he thought he had a good setup. You know what I mean? So that's definitely something to take away. You got to press it, and definitely being a leader. If you're going to really press it, you got to be in the right stock too. So that's all about the large size, and you got to have it. You got to learn how to manage that size at the right time. And even when you're in cash, you got to be engaged. You got to be studying the market. The more ideas you can track, the better. Which is why I have my service. We look through all the trades and log all the stocks we're watching, and start to build the case for buying the next breakouts as they start setting up, and as groups start to firm up and the market firms up. So there you go. So yeah, when to sit out. So obviously swing trading against the market decline makes your odds go lower, right? So in this sell-off right now, the breakouts are not working great. It's in select groups, and they're all throwing back. So that's lowering your odds. A few will work, though, and that might suck in a lot of traders, and that's like a big trading error when you see one or two stocks work and everybody goes crazy for it. And sometimes those stocks are only working because that's the only thing everyone's trading. You know, if enough people buy a stock, I mean, the price goes up. So you're going to have something like that. Like BRCC recently, I didn't trade it, but that was like kind of a nice entry. And I think we were talking about this yesterday. Everybody kind of got, you know, excited about it, whipped up about BRCC, and that thing kind of flew and then it dumps out. So, you know, using that as a good example for risk management, it definitely sells some into strength, and you got to move your stop up. You know, even good conditions can be tricky too. So if for some reason you're not making money on good conditions, you still have to pull back, right? So that's the other thing. You're just not in sync with the market. You got to recognize that. For whatever reason, it could be personal. Maybe you're buying the wrong stocks and you're just on a cold streak, and you become your own fade, right? So you don't want to do that. You got to check the indicators when everything's deteriorating, and you can sit out. And when you're not following your system, when you find yourself kind of trading other styles all of a sudden, that's like kind of desperate trading or whatever you call it. You know, it's just you're trading outside your system. I would say you should probably cut yourself off. You know, that's the way to go. And when to go for it, you know, using the house as money is obviously the best way. So like if we go to blackjack tables later, you know, my play is small until I start making some money, and then I'll start pressing that. It's kind of the same with stocks, of course. So, and you got to be careful after your big gains. There'll be pullbacks, so you don't want to press at the wrong time up. You know, so you got to do it with proper risk management. That's for sure. And if you're getting traction in select groups, despite what the market's doing, you know, by all means, you know, you can press that a little bit as long as you're using good risk management. I mean, that's just, you know, my methods there and what I do. So if your stocks are trending and you're moving stops even or better and taking profit scales, things are working then. Playing carefully and small until you gain experience is usually a good move. So say you want to start trading like this and say, I want to be a high tight flag expert, everyone should definitely go for it. You know, practice small, don't go crazy. You know, it takes a lot of practice, a lot of years to really get the timing right, and go through different environments to match, you know, things up correctly. So, all right, well, thanks so much. You know, I don't have championtrading.com is kind of where I hang out and put all my trading and stuff, and everybody wants to come check that out and come meet me after. And thanks for having me. And I think I'm out of time here. I don't know if anyone has any questions or anything. You want to do some of that? Got 5 minutes. Yeah, go ahead.
For your earnings pivot, could you talk about your...
Sure.
For earnings pivots, could you talk about your day one trade plan, how you're entering, how you're setting
Yeah,
stops?
that's a good question. And I'd rather do this than read slides, obviously. Yeah, so the earnings pivots, what I'm doing is this is a little bit of a fishing expedition. When you're going to do an earnings pivot, it's going to take a lot of time. You're going to do a lot of different setups. You're going to have to go through a lot of earnings pivots to get a good one, because they can gap up, they can gap down. So you're going to get it just right at the buy point. It's going to be rare, but it's worth doing, and it's worth waiting for. So you want to see it open inside or at the buy point and then press higher, and you're buying it as it's doing that really early in the day when you see some volume. And usually there's good volume on earnings. So it's a good question. But yeah, hopefully I got that for you. Does that make sense? Okay. All right, guys. Well, definitely meet me at lunch over there. Thanks for listening. Thanks for coming out and supporting. I appreciate it. Thanks, guys. Hopefully that was good. We'll see. All right.
All right, everybody. Thank you so much for attending. I hope you enjoyed this as much as I did. One more time, big round of applause. There we go. Hey.
Thanks, my man. Appreciate it.
Thank you, sir. Okay, we are going to break for some delicious lunch now. It is going to be served in the room that breakfast was, and then we will be back in 1 hour at, I believe, 12:20, 12:25, and we are going to have our first panel of the day. So, looking forward to that. I will see you back here then.
all right. Someone have a good lunch? Yes? Medium? Good? Okay. All right. We've arrived at what I would call the home stretch of the conference here on day 2. So let me bring on or introduce our moderator for our second to last panel of the day. Nathaniel Baker, Senior Pro at Seeking Alpha. Nathaniel, welcome to the stage.
Was it real or just for show? She said, Savior. Jeez, baby, I just gotta know how long has this been going on? You've been creeping around on me, oh, you're calling me baby. How long has this been going on? You've been making some shade.
He has been a Seeking Alpha contributor since 2017 and is an economic analyst, there we go, providing research on how economic cycles impact asset prices. Eric holds a bachelor's degree in economics from New York University and has been studying economic cycles for almost 10 years. He's a former buy-side analyst at Panorama Partners, a quantitative hedge fund, and is the #1 most read economics contributor at Seeking Alpha. Eric also runs a premium subscription service called EPB Macro Research. I'm assuming those are your initials. And on Seeking Alpha, this is part of the Marketplace program, and his service helps investors understand the economic cycle so that they can generate consistent profits in the market. Lewis Stevens from Jacksonville, Florida, has been a Seeking Alpha contributor since 2018 and leads the #1 rated service for growth investing, which I guess that still exists. Lewis supports a community of long-term oriented 3, 5, and 10-year timeline investors who look for 99th percentile cultures created by 99th percentile founders that produce 99th percentile growth economics. Lewis and his community view their investments as an ownership of real companies and as long-term partnerships with the founders and management at the helm. I turned that thing off by accident, sorry. His first stock that he ever owned was Walmart in the early 2000s. Quite a good trade there. All right, let's kick it off here. I'm going to start with Eric. Big picture first. The elephant in the room, the Fed tightening, the economy potentially slowing down. First quarter GDP was negative. It may have been an outlier due to the Russia-Ukraine thing, but if we get another quarter like that, that's technically a recession. And the Fed is tightening, like I said. Will the Fed be able to guide us to a soft landing, something they have maybe never done before? Some could argue they did it in late 2018, perhaps. Or is a recession inevitable?
Yeah, so coming out with a loaded question.
Yeah.
Right? So sort of just to set the stage for how I contextualize the world, how I think about economic cycles, there's what we call secular economic trends or structural economic trends. People may be familiar with that term, or trend economic growth. And what these secular economic trends are describing are the long-term potential of the economy. And that's not static. People think that trend growth is 2%. That means the economy moves at 2% in a straight line. It's not necessarily true. So what defines secular economic trends is demographics and debt. And sadly, we have worsening demographics and ever higher debt levels. So what that means is that the secular economic trends are going to be pushing economic growth lower over time. But that's a very long-term forecast. That's 3 to 5 years or longer. On top of that structural or secular economic trend, we have cycles or cyclical economic trends that come and go on top of that structural growth. We had a recession with the COVID lockdowns, and then the economy accelerated pretty sharply out of that lockdown, and the economy hit a peak rate of growth in the second quarter of 2021. Since the second quarter of 2021, the growth rate has been decelerating. And people may say that the growth is still high or growth is still good, but in my framework, all I'm looking at is the direction of growth. So if growth is moving from 8% to 2%, that's negative. If growth is moving from 0% to 2%, that's positive. Even though you're ending in the same spot, 2% growth, one, you're decelerating, and one, you're accelerating. So getting back to the question, we have declining long-term economic trends, and since the second quarter of 2021, we have decelerating cyclical trends. Every time the economy is decelerating, by definition, a recession is becoming increasingly likely because the growth rate's moving closer and closer to zero. So at face value, the odds of a recession are rising each and every day just based on the fact that the growth rate in the economy is decelerating. When you add the Federal Reserve tightening monetary policy into decelerating economic growth, it makes the probability of a soft landing a lot lower than it would be otherwise. Generally, when economic growth is decelerating, the Federal Reserve is easing monetary policy. But we have a conundrum now where the economy is decelerating, but the inflation rate is quite high. So the Federal Reserve is tasked with this policy of trying to bring down the inflation rate while also not slowing the economy any more than it already is. Sort of an impossible task. With that framing in mind, I would say that the probability of a soft landing in the economy is quite low, given the assumption that the Federal Reserve executes on the monetary tightening that's priced into markets. The Fed is projected to raise interest rates to 3.5% by the end of next year. If that path comes to fruition, the probability of a soft landing, I'd say, is probably close to zero. Now, the real elephant in the room is, when does the Fed pivot? We all know that they will pivot at some point and go back to easing monetary policy, but if inflation isn't fully under control, they'll have to keep tightening even though the economy may already be in a recession. So given the dynamic of weakening structural trends, declining cyclical trends, and a Federal Reserve that's about to engineer one of the largest monetary tightenings we've ever seen, that puts the probability of a soft landing, in my opinion, quite low, unless that we get some sort of about face and a pivot from the Federal Reserve.
Interesting answer. Wow. Yeah, that really sums it up. As a quick follow-up to you, right, so there are not all economic indicators are bad. You look at employment, we're pretty close to full employment. Is there a chance here that the economy, the growth carries us through? You still have lockdowns coming off. Okay, there's no more stimulus, but there is still potentially a lot of liquidity in the system, depending on who you ask. So is there a chance that the growth here could continue through these next couple quarters, I guess, and through the Fed tightening cycle, in your opinion?
No, that's a great question. And I would say that in the way that I look at economic data, everything is in rate of change, or in fancy calculus speak, the second derivative, right? Yeah. So, when I look at employment growth, I'm not looking whether the employment growth is good or bad. I'm looking at whether it's accelerating or decelerating, right? And to your point, however, employment growth is not yet decelerating, which is quite interesting because you have income growth, real income growth, so adjusted for inflation, that's declining really sharply. You have consumption growth, which is declining because stimulus is wearing off and people already bought a lot of goods. So you have income growth coming down, you have consumption growth coming down, and you have industrial production growth coming down. Employment is the fourth leg of that stool. So you have 3 of 4 trends that are declining with employment growth that's still accelerating. So the only thing that's keeping a recession from being in the extremely near-term horizon is that employment growth is still accelerating. So one thing to look for would be that if we do have a pivot or we start to see declining rates of employment growth, because right now employment growth is 4%. And if employment growth falls to 0%, that's obviously a recession, right? But in order to go from 4 to 0, you got to go to 3 to 2 to 1. So if you start to see the growth rate of employment start to crest and move lower in conjunction with income growth falling, consumption growth falling, that would mean that the likelihood of a recession is getting extremely high. But I think that that's a valid point, that employment growth is still not yet decelerating, which means that that's pushing the probability of a recession a little bit further into the future.
Cool. All right, great answer. Thanks, Eric. All right, Louis, let's move on to you here. The markets, state of the markets, obviously, you don't need me to tell you it's bad. April, the NASDAQ was down 14%. That was the worst month since the financial crisis. And it's very strange how at the start of the month, we had all these reports about what a great month April is for stocks, historically the best month. As the month went on, those reports got quieter and quieter. And now it's a punchline and a joke. But last week, we had the biggest drop in indexes since 2020. Is the worst over, in your opinion, or is there still more pain to come for investors?
Well, first, I'd just like to highlight something that I found very noteworthy, which is that Eric and I had not met before this, yet today we are wearing precisely the exact outfit down to our socks. We both selected dog socks. I think this is
with
something.
One exception.
This is,
the
I
tie.
mean, I
Yeah.
noticed it. Oh, the tie. Well, yeah, the tie. I noticed it as I was getting up here. We are both wearing dog socks. So that there's some kind of cosmic alignment. So I congratulate everybody for spending time here during this very noteworthy cosmic alignment. As for a prediction apropos the market, so Eric provides a very, as it's called, macro perspective. He provides a very 50,000 foot view. In my estimation, the ideas that he shares are playing out over the lifespans of societies. So, the ideas that he's sharing, they play out over the rise of the Roman Empire, the prosperity of the Roman Empire, and the collapse of the Roman Empire into fragmented kind of little like feudal states that then rose and became prosperous and were ultimately governed by the Catholic Church and so on and so forth. And there's a lot that we can discuss in this realm. And I think Eric does an absolutely fantastic job, and he's really enlightened me on a lot of things. Today we've been talking for hours, and it's been a really fun conversation. But in my little area of the universe currently, I take the diametric opposite perspective, and I think both of our perspectives are almost philosophical in nature. Like the perspective that I take is very it could be considered micro, but the perspective that I take is inverting a view of the world from employment or GDP or interest rates or the rate, the population growth. All of these things are related to the rise, prosperity, and decline of societies. And for those that are really enjoying this ride on of American society, there will be a point at which it comes to an end, and great things will rise from that point going forward. But from my micro perspective, I'm analyzing companies and their formation, their rise, their prosperity, and their decline, right? So from my neck of the woods, I focus specifically on companies, I focus on businesses, I focus on the structures within those businesses, I focus on income statements, balance sheets, cash flow statements, I focus on what competitive moats these companies have. I focus on their rate of growth, their unit economics, these ideas. In the same way, and I say it's philosophical, in the same way that everybody in the audience right now, you're not necessarily living your life through the lens of the rise, prosperity, and decline of the American society. You're living your life through the lens of, how do I enjoy this day? How do I maximize the value of this day for myself? How do I maximize the value of this day for others, right? So we look at our work in this very micro perspective of, how do I structure a business, and this is a portfolio, we call a portfolio, a business of owning businesses, in such a way that the business of owning businesses has the right values, the companies that we own within that business of owning businesses have the right values, which both of which, those ideas translate into the economics of those businesses and thereby the returns of the overall business of owning businesses, the portfolio. So to answer your question, right, I am unable to predict the rate at which societies are strengthening, stagnating, declining, whatever it may be. And I actually do think that there is a way to predict it. And Eric and I discussed a lot today some of those metrics that kind of illustrate at what point society kind of finds itself. My goal,
Well, hang on a second. What are some of these metrics while you're at it?
Sure. So I think, well, Eric, you can answer the question, but I think one interesting metric is debt, right? Every society kind of finds itself mired in debt prior to a challenging period. But I don't know, Eric, do you want to kind of comment on that?
I think that if you're looking at the long term, then you want to be focused on slower moving variables like population growth. You want to look at the structure of that population, so the age. So is the population aging? Is the population getting younger? You want to look at debt, but then more specifically, you want to look at, is that debt being used productively or unproductively? If I can, I'd like to take a stab at the "are we near a bottom" type question. Going through it from my framework, again, I'm looking at these cycles in growth. Is growth accelerating or is growth decelerating? And I assume a lot of people in the room been involved in markets for a number of years. And if you go back to 2009, coming out of the great financial crisis, from 2010 until 2020, we had one long business cycle expansion. There was no recession from 2010 through 2020, but we had 4 distinct cycles in growth. If investors in the room recall, coming out of the COVID period, of the Great Recession period, there was an acceleration in growth. Then into 2011 and 12, there was a period of declining growth that coincided with the European debt crisis that caused turbulence in markets. Then there was an acceleration in growth from 2013 to 2014, positive for the markets. Then from 2014, 2015, 2016, there was a decline in growth. Oil prices went to $20 a barrel. There was, a quasi-manufacturing recession. Then from 2016, 17, and 18, we had an acceleration in growth, very positive for the markets. And then from 2018, 19, we had a decline in growth that predated COVID. Federal Reserve was cutting interest rates prior to COVID. We were maybe on our way to a recession. My point in outlining all of that is we've had several declines in economic growth that did not end in recession. And when I look back on these growth rate cycles over the last 30 years, whenever you have a decline in growth, asset prices perform poorly. But when you have a soft landing or a growth cycle that does not end in a recession, like 2011 and 12, 2015 and 16, and even right at the end, 2018 and 19, when it does not end in recession, historically, you've never had the market go down more than 20%. And as we sit here today, the S&P 500 is down exactly 20%. And that makes sense because we are in a declining growth environment. So the question of are we at a bottom or not entirely depends on, is this a soft landing or a hard landing? If this is a soft landing and we avoid recession, then very likely we are very close to the bottom because you're not going to have a decline in excess of 20% without a recession. However, if we do cascade towards a recession, then there is going to be more pain to come. So if you have an opinion yourself about whether we have a hard landing or soft landing, that may help you determine if we're close to a bottom. My framework tends to lean more towards the hard landing camp. So I think that the probability of a bottom is less likely because I think that the probability of a recession is higher. But if you take the view that we're not going to have a recession, then declines of more than 20% are extremely unlikely.
To piggyback on that, I think to get, to just discuss the valuations within the market, because within this business of owning businesses, we're very focused on valuations of equities. So I would say portions of the market indicate that we are already, we are in a recession. Portions of the market indicate we are in at least the initial stages of a liquidity crisis. Portions of the market, especially like high yield credit, the entire bond market. We are in the worst bond market since 1842. The bond sell-off thus far, I don't know precisely, but the current bond sell-off, we haven't seen such a dramatic sell-off since the signing of the Treaty of Versailles to conclude World War I, right? So, for those wondering if we're, it's in my opinion, it's almost irrelevant to be asking it at this stage for certain equities, for a large portion of equities really in the market, right? Basically all of FANG outside of Apple and Microsoft have experienced their worst declines on record or since 2008, right? So for a lot of the market, we've already priced in, we're headed for a dramatic liquidity crisis. Like we're there, we're already there. That being said, and I think this is interesting, in the 70s, a lot of small companies priced in the 73, 74, 75, 76, market re-rating, higher inflation. There was, liquidity crises during that period. I will say that at the time, real estate did very well throughout the 70s. That's certainly not being priced in right now. We're pricing in a very tumultuous real estate market, which Eric has shed a lot of light on for me throughout today. But we have, within I focus specifically on basically sub $20 billion market cap companies that are growing between 20% and 100% plus, right? All of these companies have priced in a violent recession to a degree, a liquidity crisis. But I don't think that everything is priced this in. And I mentioned the 70s because during the 70s, a lot of small companies priced in the 73, 74, the mid 70s, the liquidity crises, the sustained inflation, the higher interest rates, which, when you have higher interest rates, valuations re-rate. And I won't get into what I call the immutable laws of money, but there are immutable laws of money governing all of this. And we've talked about that. If you really take it to its atomic unit, it's the laws of physics governing all of it. But so what's interesting is that not everything is re-rated. You see the QQQ down almost 30%, or the SPY almost down 20%. And it's like, there's still a lot of companies that people are holding on to that they won't sell, or that have been pushed up in valuation as a part of this almost mindless algorithmic rotation of growth to value trade. So we find ourselves, if we continue to print inflation hot, and we discussed it today, if you read the language of the Fed from the early 1930s, and I think people might be saying we're not headed for the Great Depression. My point about my initial discussion is we have no idea. We have absolutely no idea. Nobody can truly answer the question, but it's valuable to consider these ideas, undoubtedly. But if you read the language of the Fed in the early 30s, it was funny because, I guess it wasn't funny because there was a lot of suffering, but the language they were writing in these Fed minutes was, should we take our foot off of the neck of the economy? And another Fed, chair member is like, no, we need to keep the stock market's down like 80, 90%. They're like, no, we need to keep ratcheting it up. We need to keep ratcheting it up. So ultimately, we have no idea what this, centrally planned economic system has in store. And that's why I started my conversation with, it's almost philosophical, because, from your business of owning businesses, your portfolio, it has to be constructed from within. There needs to be values attached to that. And if you're running a business of owning businesses, especially buying individual stocks, your mental, your emotional state, your psychology, it is going to be tested, and it's going to be brutal. It's absolutely brutal. And we have people can go out and say, well, I'm going to buy this safe stock. I don't know that there's a safe stock in the economy. If interest rates rise, if the 10-year rises to 6%, and we've got Fed circa 1932, should we take our foot off the neck of the economy? And the other Fed chairman says no, inflation is going to destroy the hegemony of the United States, right? We need price stability above all else. the currency is, we're seeing in Bitcoin, altcoins, all this stuff, right? Inflation, the destruction of these currencies, it's catastrophic. So, we just don't know, you don't know where interest rates are going to ultimately go. And maybe we can move on to another question, but I think Eric has some very interesting ideas on the idea of interest rates. But if interest rates, if the 10-year rose to 7%, 8%, we've got another 50, 60% downside, like easily. So that's why I started my ideas with a philosophical discussion, because you'll get more philosophical as the stocks keep declining, right? So
sure enough. Yeah, but I mean, this is not the 1930s Fed, right? I mean, all these men and women are pretty dovish if you go into like their history and their comments and stuff. And Powell reversed course once before in late 2018. Granted, he didn't have inflation then, but I mean, is it really realistic to expect the Fed to be like have their foot in the neck of the economy? Like,
well, I think Eric's got great takes on, if you can imagine a bowling alley, right? When you're young, you can't bowl down the bowling alley. There's guardrails. I don't know. What would you say the guardrails are in terms of the Fed's decision making here, related to debt or stuff like that?
Yeah, I think that based on the structural forces that I was mentioning in the beginning, the declining demographics and the excessive debt load, that the probability that the Fed's able to raise rates to 3, 4, 5, 6% is pretty close to zero. So I'm not worried that the Fed's going to raise rates to 6% or anything like that. I don't know what the Fed's reaction function will be. We've never in modern time been in a situation where we have high inflation and they're raising interest rates. The perspective that I would give is that the current carnage that we've seen in the market doesn't bother the Fed at all. We've seen destruction in cryptocurrencies, which doesn't bother them. We've seen destruction in some pockets of the stock market that doesn't bother them. What really bothers the Federal Reserve is the credit market and freezes in corporate credit, because that's really what's going to impact employment. In March of 2020 during COVID, the commercial paper market totally froze. And for people that aren't familiar with the commercial paper markets, short-term liabilities of corporations, and large companies finance their payroll in the commercial paper market. So you take a big company, maybe like Boeing, and they don't have the money to pay their payroll every 30 days. They borrow it in the commercial paper market. So if the CP market totally freezes, you're looking at mass unemployment in a matter of weeks or months. So that's what worries the Fed. So if we're looking for what's going to make the Fed pivot, it's not cryptocurrencies going down 90%. It's not the S&P going down in a very orderly fashion. It's credit freezing and unemployment that would follow. And I don't think that we've seen anywhere near the level of destruction in the market so far that would cause the Fed any concern. In fact, I think it was Thursday maybe that the market was down quite a lot. And one of the Fed speakers came out and said, we want to see financial conditions tighten even further. Yeah. So they're really not worried about froth coming out of the market. In fact, that's actually their explicit goal right now, is to get a lot of the froth out of the market, have a lot of non-economic investments, if they're worth zero, go to zero. But what worries the Fed is credit, and we're not there yet. So they are going to keep going for the foreseeable future, and then we'll see what happens with the credit market.
Has inflation peaked?
In my view, inflation has peaked in terms of the actual rate of inflation. The path of inflation going from the 8% level back to 2%, that's going to be an extended path. I don't think it's going to fall, in a matter of a couple of months. But I think that the absolute rate of inflation has peaked, barring another shock to commodity price. Like, you get oil to 150, 160, maybe we'll have another bout of inflation. But barring another commodity price shock, then I think that the peak rate of inflation is in.
Okay. This has all been much more macro-oriented than I was anticipating. I thought we were just going to have one question. But this is nevertheless fascinating. But I do want to move on. Louis, what do you think now, all of this big picture stuff aside, where are opportunities?
Sure. So, you buy a stock to grow. And for Peter Lynch fans out there, right, that's, he introduced a discussion he had on PBS with that one line. And that line really repeats in my head often, right? You buy a stock to grow, and I don't think I don't think it's a secret that that's the case. In fact, I would say that was consensus for the past 24. I wouldn't say 24 months. I would say 60 months, right? Valuations for the equities that can really generate significant returns, the equities where you buy them and you're able to just do nothing after you've bought them for 3, 5, 10, 20, 50 years, right? I've been saying that my favorite timeline is the timeline of you will take this out of my lifeless clutches, right? I'm going to own this stock irrespective of whatever macro forces derail it, because ultimately the macro forces can eliminate growth in the near term, right? The Fed can shut down the market, can shut down credit markets if it wants to. There's a whole discussion about how much pain society wants to endure, how much pain the government wants to inflict to delay gratification, to save the empire, so to speak. But within the realm of growth investing, sub $20 billion market cap companies, I mean, it's been as catastrophic in terms of the valuation re-ratings as 1999, 2000, 2001, 2002, 2006 to 2009, right? A lot of companies are trading at their lowest valuations on record, and simultaneously, and I think this is extremely important, these companies are more well capitalized than they've ever been, right? A lot of the companies out there, like for instance, Roku, and I think Roku is a very quality company. I think it's a well diversified business. I think it has a series of shades of the four principal moats: brand, network effects, scale, and embedding. I think it has shades of each of those moats. And for those that attended the software discussions earlier, Muji and Software Stack Investing, they did a fantastic job illustrating what the four competitive advantages, especially in the digital realm, especially in our universe today, are, which Warren Buffett doesn't like tech, and the entirety of his performance over the last year. My mic went out. Okay. Has been tech governed by the four moats of brand, scale, embedding, and network effects, all of which Apple has in spades, right? So my point is, there's a lot of really high quality companies out there with immense cash balances, right? I recently saw, I don't know if any of you guys are familiar with this individual, but Keith Rabois, he's one of the original PayPal founders. He's trying to lift San Francisco and put it into Miami with varying degrees of success. But it's interesting nonetheless. But he retweeted something where somebody illustrated. It's funny because you'll see just the cognitive dissonance, the mental gymnastics in the market. It's very interesting. But he retweeted somebody that said, having too much cash, raising too much capital can become a bear thesis, right? If a kid gets too much money as a child, he raises too much capital early on, so to speak, he becomes a spoiled brat, and he fails as a productive citizen in society because there's a bunch of inefficiency that results from having too much money, right? In the early 2000s, the inverse was the issue, right? The principal characteristics of a lot of companies that failed in the dot-com bubble were, number one, they were not well capitalized. They didn't raise enough during the peak of the mania. And if they did, it was debt financing, so they had giant, levels of debt. And then number two, they often, really kind of lacked product market fit, or at least sustainable product market fit, right? I think today the internet is extremely mature, the digital realm's extremely mature, the anti-tech, and I'm a huge admirer of Warren Buffett and Charlie Munger and Peter Lynch, and these are my heroes as investors, undoubtedly. But even the anti-tech Warren Buffett is now principally reliant on the performance of of Apple, which is technology, or Visa, which is incredible technology created by D Hawk, which is an individual worth looking into. So my point is that there's a lot of companies out there that are sub $20 billion market cap that have profound product market fit, positive unit economics. They're extremely well capitalized, meaning they have tons of cash and either no debt or on a net cash basis, meaning cash minus their long-term liabilities. They're net cash positive. They have so much cash that it's almost a bear thesis. And so these companies are now trading at the lowest valuations on record while having profound product market fit, diversified businesses, often conglomerates, and tons of cash. And they're just getting beaten into the earth.
Any examples?
Yeah, well, I mean, Roku's one. Examples, you know, my examples are controversial because they're getting beaten into the earth. But you know, Roku's one, Affirm's one, right? So I'll show 3 examples, and then I'll turn it over. I'll conclude my thing. But so in the mid '70s, Warren Buffett bought the Washington Post, right? And that was one of his most successful investments of the 20th century. At the time, the Washington Post had declined 80 to 90%. The Nixon administration, and this is reminiscent of Facebook, the Nixon administration was targeting the Washington Post because it was releasing damaging documents. Advertisers were boycotting the Washington Post, down 80 to 90%, right? Inflation was raging. There was liquidity crises because the Fed actually manufactured those liquidity crises. And Warren Buffett was buying the Washington Post, right? So we see Facebook as the modern media conglomerate. We feed off of the political, you know, attacks on it because it just demonstrates how powerful the company is. And we think it's a great value with a ton, you know, net cash of 35, 40 billion. We like Affirm. It's, you know, we think of it through the lens of an early Amex, right? I think something that's interesting is that in the 60s, this is just a random bit of information, but in the 60s, credit cards were seen as, you know, profligate spending, right? They were seen as risky businesses. Bankers in the 60s were telling banks that were adopting credit cards that you're going to lose your shirt if you have a credit card program, right? Affirm is a buy now, pay later platform. And today you hear the same rhetoric being applied to Affirm. If you buy now, pay later, they're going to lose their shirts, this, and that. And it's like, you know, auto financing in the 50s was a risky business. Like it came into existence and people didn't think it was a good business. Credit cards in the 60s were a risky business. You know, anyway, it's still actually, you know, credit cards are still a risky business if you can't manage risk, and that's why only, you know, it's been consolidated in the largest banks. Anyway, Affirm, Facebook, Roku. We like all 3 of those.
All right. I do want to take some questions. We're in the last quarter of an hour here. Is there a mic that's circulating so we can, if there are any questions, if not, we can move on.
All right, great commentary so far. Thank you both. Eric, you talked a little bit of the odds of a soft landing versus a hard landing and that sort of thing. What would be sort of the Goldilocks scenario where inflation can become under control without driving a recession? And if, first of all, what's the odds of that? If you think that can happen? And then secondly, if that Goldilocks scenario does happen, what are kind of the winning sectors and losing sectors in that scenario?
So I think that the Goldilocks scenario of inflation coming down without hurting employment would have to rest on the supply chain issue. If supply chains magically went back to normal tomorrow, then we would see inflation come down precipitously without the Federal Reserve having to tighten policy all that much. So I think that it hinges on some of the supply chain issues. If the supply chain problems don't alleviate themselves in the next 3 to 6 months, you're going to get another 150 basis points of interest rate hikes. You're going to start unwinding the balance sheet. Longer that drags on, the more tightening you're going to get, the lower the chances of that happening. So I think that if you're hoping for a Goldilocks scenario, you would need inflation to come down extremely quickly. And I don't see how inflation can come down extremely quickly without a recession, unless it's a complete restoration of the supply chain issue. Inflation could come down quickly in a recessionary scenario, but in a non-recessionary scenario, it's going to have to be supply chain related. If we do have a Goldilocks type scenario, then I think all risk assets do quite well again, because you'd have a total reversal of everything that's priced in terms of the monetary tightening. We would have the interest rates would come down, and if interest rates come down, then the sectors that have been beaten up the most as a result of these rising interest rates, so some of your high growth sectors will probably rebound pretty substantially. And I would think that your general risk on sectors would do quite well. So, maybe financials, things like that. So I would think that if you do engineer a Goldilocks type soft landing scenario, then pretty much any risk asset will do quite well, just based on the lowering of the discount rate, and probably the sectors that have been beaten down the most, probably high growth would probably do the best.
Eric, in percentage terms, what would you gauge the percentage of a soft landing versus a hard landing?
I would put if your outlook is 12 to 18 months, I'd put the odds of a soft landing. I would say probably below 25%.
25%.
Yeah, probably lower than that, I would say.
All right. Well, there you go. Any other questions? We can move on. I don't see any. Right. Okay, cool. Yeah, so let's talk a little bit about how you guys do your research. And you have Seeking Alpha, obviously, which is the platform where both of you guys find yourselves. Some data here on our numbers at Seeking Alpha. We do a whole bunch of stuff beyond just contributor articles, which you guys both contribute. In terms of research, how do you guys go about doing it? Do you use, like Lewis, do you use screens? How do you go about finding your stocks? And any particular tools in Seeking Alpha that you like?
Well,
besides all.
Yeah, no, I mean, I do want to give it a shout out to Seeking Alpha. It is the best investment research platform on the internet. I stand by that in the same way that I stand by Facebook being the modern day Washington Post, which is reasoning by analogy, and it's a big no-no. But I do, from a individual perspective like Facebook. No, I think once you understand a sector, once you have informational asymmetry within a sector, you understand a sector very well. I think that gives you a lot of confidence in the businesses that you own. Effectively buy what you know, right? If you, like, I frequent Chipotle multiple times a week, and I've been doing this for a decade now, and I never get tired of it, and I still love it, and I still look forward to it, and I won't eat anywhere else in the fast food realm. Well, I eat Chick-fil-A, but mostly and if you go out with me, I will eat somewhere. But anyway, buy what you know. Buy what you know.
So turn off your mics. Yeah, thanks for that. Buy what you know. Yeah, right. Okay, Eric, what about you? I mean, macro is not necessarily our thing, but we do have a bunch of stuff. What do you?
So as a macro analyst, most of the information that I get is government type data, economic type data, but the way that Seeking Alpha is incredibly useful for me is that because I'm macro analyst and I'm macro focused, I have a broad view of the way the world works and where the economy is headed, but I don't have sector specific knowledge. And I get questions all the time, so if I say we're in a decelerating growth environment, there's a whole bunch of sectors that maybe will perform poorly or perform well. I'll maybe get a question about a specific company or a specific sector that I'm not very knowledgeable on. And Seeking Alpha has such a wide array of authors and contributors that are specialized in certain areas that I can just type up someone's name that's a specialist in a certain sector and get an unbelievable amount of information on that, better than I can do. And I think what sets Seeking Alpha apart from the other financial media platforms out there is that Seeking Alpha has really serious analysts. Seeking Alpha is not a collection of bloggers, right? Lewis is a serious analyst. Two people that are here, Jay and Michael, I mean, they're really serious industry experts. So if I want to go and learn something about the shipping sector or the energy sector, I know that I could find some of the best analysts in the entire, on the street, basically, and I can look up their research. It's not a bunch of bloggers that are just sitting in their basement typing up articles. So the specialization across all the different niches is what makes Seeking Alpha super useful for me, that I could get basically information on anything that I need to know from an industry expert. I can cover the broad macro space, but I can't dial down into the specifics. Other people can do that better than I can.
Yeah, just a real quick last thing about give a quick plug for our pro subscription business. This is what I help run, and we basically curate the best ideas that come through Seeking Alpha on individual stocks each day and write up little highlight blurbs on those. All right, enough of that. And are there any other questions here before we finish up? Because I had some. I want to go.
There could be any questions. Any questions?
Yeah.
We can go back to the discussion on our dog socks, because I think I genuinely believe that's probably the most noteworthy thing of this entire experience.
Let me ask you about Facebook.
You have a
you got a question?
You got a question, Jay? You can shout it out.
Oh, without a doubt, but I have coming back to the discussion. Life, if life were easy, it just wouldn't be worth the whole journey, right? Macro's scary, life, death, everything's scary, right? My point about this is, I've structured my psychology in such a way that I try to just focus on controlling what I can control, operating within my perception of what will yield the best results, which is just a business of owning businesses where I own what I know and own it in perpetuity. To your question, yes, I don't even want to. Maybe it's wrong to be superstitious about it, but I made a bunch of bearish calls, and a lot of them were. Almost all of them were vindicated. I think just generally speaking, all stocks trade sub 10 times sales long term. If the company has 75% gross margins, 35%, 30%, 25% free cash flow margin, meaning that's how much cash it produces out of a dollar, you get 25 cents, 30 cents, 35 cents, right? That stock's trading sub 10 times sales long term, right? And I was pounding the table on this idea, which is, I was pounding the table on the idea that stocks are going to trade sub 10 times sales, right? So a lot of the companies that were 40, 50 times sales have stagnated for years, have, reverted, are down 80, 90% and then some. But then, of course, discriminate that only in the fullness of time will certain ideas be vindicated. Truth will only be revealed in the fullness of time of 36. Like Peter Lynch says, my best investments materialized 5, 6, 7 years. Right? It takes. Business is a very, very long, and it can be arduous, but if you have the right values, very easy. But it's a very long journey. And, but to answer your question, yeah, there was a lot of very obvious shorts, especially in January 2021. But I hate doing it because, people get so emotional about the shorts, and then you come out, you're bearish, and then you get an idea wrong, and then they're dunking on you. And then I just get this whole nasty experience. So I'm long certain companies. I respect everybody's positions. I just try to stay in my own lane and enjoy the ride, ups and downs, and everything in between.
Real quick on Facebook, though, you're bullish on the metaverse. You think that pivot is good?
Oh, I appreciate the question, because in October of 2020, September of 2020, I published an article entitled "Introducing President Mark Zuckerberg." Right? Everybody's talking about the metaverse as if it just materialized in Facebook's consciousness. In 2015, Zuck was trying to buy Unity Software, which is a metaverse platform. It's all of the video games you play on mobile devices, they're often built in Unity Software. In 2015, Zuckerberg was trying to buy this platform, and he was saying, the only way you can break the duopoly of iOS and Android is to get in front of the next great computing platform, which is virtual reality, augmented reality. So we've known that Zuck was going to do this. We think of it as, you know, Microsoft built its monopoly by 99, 2000, 2001. Growth kind of leveled off, but you know, they were building Azure and the Xbox and all of this stuff, right? And we look at Facebook right now as just in the gutter. It could get cheaper, it could, and this is my point. Everything can get a lot cheaper. I promise everybody, you know, if the Fed, you know, we don't know what kind of reckless maniacs are at the Fed. With all due respect, with all due respect, I don't want to, you know, get unprofessional in that regard, but you know, if you read the Fed papers of the 1930s, you would think, you know, who knows what was going on in their heads. But no, I think Zuck is going to do a great job ushering in, you know, the next chapter of Facebook. He's young. We like Zuck. We kind of see him as Justin Bieber of finance. He got too much money too fast. He made some mistakes, and you know, that's what happens.
I was thinking where I can go with that analogy. Maybe I won't. All right, that's actually, we're out of time here. Please join me in thanking the panel. And I'll hand it back to Benzinga.
All right. Let's give our panelists one more round of applause. Great job, guys. We have come to the last panel of FinTwit 2022. This is the one, I'm going to call this one almost the airing of the grievances. If you've ever wanted to wonder, if you ever wonder like, oh, why does this platform do it this way and not that way? I want this feature, I don't want that feature. This is the panel for you. We're going to talk about what makes a good platform for traders, right? You all are traders out there. You all use platforms, and you all have things you like and things that you don't like. So we have now joining us a panel of people who all run trading platforms in some way, shape, or form and have input on those platforms. And so what I'm going to do is I'm going to introduce our moderator and have our moderator introduce the panelists. So if we're all good on the AV front, are we all good? We're all good. All right. Daniel Stack, why don't you come on down? He's the director of customer at AlphaStream. Let's give Daniel a hand. And the floor is yours, sir.
Perfect. Can everyone hear me? Thumbs up, perfect. Well, I am excited to be best to save for last. And the panel, yeah, we've got a good conversation coming up. So Daniel Stack, I'm the customer director at AlphaStream. We're a technology company that works with a lot of digital platforms and brokers, really around helping them personalize the customer experiences. And so everything from personalized news to recommendations to search. And the panel topic is, and I'm really excited to be talking about this, is around how do you create the best platform for traders? And we're going to touch on things covering what kind of look around the corner looks like, or what the future of how technology is enabling platforms to move forward and what that looks like. We're talking a bit about the convergence of social and education and learning with platforms, and also around different tools and things that really help you with your trading experience. And so to join me, I've got three really fantastic panelists. So Carolyn Bao, who's the Vice President of Marketing at MooMoo. So Carolyn, please come on up. Neal Hamilton, who's the Vice President of Growth at Benzinga. And Ryan Krebs, who's President of Cobra Trading. So before we dig in, I'd just love an opportunity for each of you to introduce yourselves and just very briefly, you know, sort of your background and the company and perspective really you're bringing to the topic at hand. So Caroline, you want to kick off and just give a quick introduction?
Yeah. Thanks, Dan. And nice meeting everyone here. My name is Carolyn Bao. I joined MooMoo about a year and a half ago, running its marketing, including branding and revenue for MooMoo. And for this entire US market. What I bring to the table are two things. One is I am passionate about really leveling the playing field for all investors that want to take better control of their financial future. I'm a sort of a personal finance nerd to begin with. And also, throughout my career, I have always been marketing algorithm and its application in the real everyday life for consumers in whichever form. I used to run Facebook advertising products, Visa products. So in my world, I think retail trading really has taken on a brand new life that requires us to demystify trading and really make it easy. And MooMoo provides this great mission. So what about MooMoo? MooMoo really brings professional trading to the hands of everyone that treats it as a serious pro sport. And I'll unpack that later for you all. But I really believe MooMoo is here to help the retail traders who wants to win, who has the will to learn.
Amazing. Neal, I'll turn next to you if you want to give a quick introduction.
Yeah, thank you, Dan. My name's Neal Hamilton. I'm a trader. I'm also the head of growth at Benzinga, which basically means that I focus on building products that match the types of retail traders that exist. There are varying levels of sophistication out there in the market, and it's my mission to make sure that every level of retail trader out there has access to easy to understand information so they can make better investing decisions. I've been with the organization for about 5 years. We've seen a lot of growth during that time, starting off with a news terminal, Benzinga Pro, and then going into some education and trade guidance services, and have recently launched Benzinga Trading School and Benzinga Options School, which is live college-style courses, live streamed every morning for our retail trader audience.
Perfect. And Ryan, please.
I'm Ryan Krebs, president of Cobra Trading. I've been in the industry for 20 plus years now. I started out as a proprietary NASDAQ market maker, flipped back over to the fintech side, and worked there for quite a while on a few different trading systems. And then recently rejoined Cobra Trading, who was previously a client of mine. And I just always felt like the retail side was really my home since I started there as a trader. So it's definitely something I'm very passionate about. And Cobra, I mean, we definitely, I guess, focus on the retail trader, the high-end retail trader, the active trader, specifically the ones that like to short stocks. So that's exactly where we try to put our efforts and focus towards. But we do a lot of other things than just that. But yeah, so we're here today, hopefully to help other traders out.
Perfect. Well, I've got three fantastic people, three fantastic companies to really talk about this topic. So the first question I really want to frame things around and talk about, hear from you about, would be around what do you think the future of retail trading looks like, and how is that relevant to your businesses? And I guess each of you probably also are traders and involved in markets. So what do you think, like, looking around the corner is a bit like? Because if you come back, I guess the market's constantly changed, and we've had this amazing renaissance of there's more people trading today than ever in history, and the market's changed constantly. And I think it'd just be interesting to hear from your point of view of how you think about it and what the future looks like from your point of view, your business point of view. Neal, I'll turn to you maybe just to kick things off from your perspective. You work with a lot of platforms. Benzinga is a platform. You've got a fantastic perspective. How do you think like the next kind of chapter of what retail trading looks like will be?
Yeah, it's more products for retail traders. I think you hit the nail on the head with options, especially in this market. Options are the easiest way for people to short something, especially for beginners. But an options contract is for 100 shares. If you're buying insurance on Amazon, for example, how many retail traders have 100 shares of Amazon on their Robinhood account or on their MooMoo account or on their Cobra account? Not many, none, I would say probably. People that have $10,000 accounts. So the future I see is similar to fractional shares. We've seen what that has done when that was introduced. Something like that with options. Fewer contracts in options. More ways to play volatility. We're seeing unprecedented levels of volatility. If you look at what's happening with VIX right now, it's at a higher base low than it has been since years and years ago. It's extremely strange, volatile times, historic. And with the new market structure of different market participants, we're going to need more products for people to play with that volatility than simply common stock options and what's available on most platforms today.
Yeah, it's a really interesting point of view, just on greater accessibility, really, on different products and ways to engage the market, and just, I guess, really to the point in time of what's going on today. That's a really good point of view. How about, just Ryan, I'll turn to you. Do you have kind of a view on where do you think like the future of trading looks like as you engage with clients and customers at Cobra?
Yeah, I mean, you know, when I think of our clients, right, and like how, you know, some of the near-term future stuff that will be available, right? Like, you know, we offer multiple platforms, you know, through Cobra today, but, you know, to his point, you know, there are definitely some new features and new software and new technology being released all the time. So, you know, I think, you know, what's going to start happening is you see a consolidation of a lot of this, right? Because if you look at some of our traders today, they have so many different applications open because they trade so many different instruments. And, you know, operationally, that's a lot to take on. And I know that there's platforms that will be released even as soon as this year that's their goal, is to try to bring a lot of that together. And it's not just the multi-instrument type platforms, right? I mean, people have been trying to add crypto to their platforms, you know, in the last couple of years anyway, but, you know, it's also the features, right? And another thing I think I see on top of that is a lot of the social, you know, components that are coming into it. You know, people are almost managing it two different things, right? You got your trading and then you got your social. Well, they want to make that more seamless. And I think you're going to see a lot of the apps, including some that are here today, right, want to integrate with that. And so I think we'll see some of that.
Yeah, that's a really great point of view. Carolyn, I'll turn to you. Well, what's, I guess, from MooMoo's point of view, how do you think kind of the future is looking, and when you think about your own product roadmap and customers who are talking to you, and what sort of triggers to mind of where you sort of see what's coming next for you?
Yeah, we're definitely seeing, to your point, by the way, just to reference some data points, you had mentioned about retail trading has seen a renaissance.
Yeah.
The data really supports that. From 2019, the retail trading average volume, daily average was 18 billion US dollars. That number was 32 billion as of November 2021, almost doubled. But with that doubling, if you kind of peel the onion a bit more, an increased amount was invested in ETF. They bought ETF, they never left, or otherwise they would buy AMC, these meme stocks, and that went all the way up to like as high as 600 million daily volume, which dropped almost to zero. So where we see as an opportunity is retail investors have really kind of woken up and realized that with little money that may not be viewed as quote unquote accredited investor in the past, they now are willing and able to invest, data shows. But where they also have found newfound power is the fact that they can connect. And the meme stock saga really proved the point that even small sort of ants or apes, when united, can act like an institution. So we believe that our job and role is to better educate them, help them to feel comfortable and capable in making those decisions, and be willing to try the strategies that may have been exclusive to their knowledge. You know, sometimes people don't know what they don't know, so that they all can just achieve the prosperity that they deserve. The second piece is how to continue making that connection easy, so that information is accessible, as well as easy for them to find their like-minded investors and make decisions in a more confident way.
Yeah, I think some of those stats you mentioned are really phenomenal, especially in those are recent phenomenons too, of just how markets develop. And I think retail participation in markets, it's really been an amazing trend. And yeah, I think to complement some of those stats, just with some of the customers we work with, I think when we look at, one stat that blew me away is just total participation in equity volume in the markets. Retail, I think, takes up about 23% last year, and that was up from mid-teens the year prior. And that's an amazing stat in many ways. And digital access to total wealth. So if you think about people investing in markets traditionally, they go through advisors and such. That's gone up to, I think, about 20% of total, and it's growing very, very fast with people trading through digital platforms. And it's Yeah, a renaissance is some term. I think it's interesting to hear just, I guess, both Neal and Ryan, your comments about kind of where we're heading and sort of the choppier waters and what people want, sort of navigate that and get through it. And I guess the journey people are on as well of, you know, maybe they started trading and now they're learning how to get more advanced. And I would love to hear, kind of moving into another question around, is there, you know, when you think about platforms and the type of users that rely and want to trade, there's a lot of across the landscape. And one thing that I don't know, and I'd love to hear your points of view on where the future is going, are we going to end up with mega platforms that offer everything, that hit huge scales, so there's one platform for everyone to trade, that has all the products, sophistication, that meets all sorts of customer journeys? Or are we going to end up with more niche, where it ends up being, you know, more specialist platforms for a certain type of person? It helps them really make the most of their journey when they want to trade with the markets. And I'd love to hear your perspectives on how you think about, I guess, how you're building your platforms, the users you're engaging with, and where you think the future's going. So I'd love, Ryan, I'm able to turn to you to kick this off. And how do you think about that?
You know, when you say platform, I think two things come to mind for me. Like, you know, the last, I guess, 15 years of my career, being part of FinTech, I think of the trading side, the trading application part platform, right? But being with Cobra, I think more of the broker and the servicing side of the platform, right? Because being a trader platform, it's all encompassing, right? So is there like one platform that, fits everybody? No, I don't think that unicorn's out there, right? And maybe one day there will be, I don't know. But it kind of goes back to my first point in the future of it, right? Bringing all these awesome things together right into one. But I think, if you speak in generalities, I mean, there's a lot of common platforms out there that people can use and that will fit most people's needs. But I think, as you mentioned, their journey, right, you grow out of it in some cases. Maybe your strategy changes, right? Your needs change. New technology comes and your current, system or broker can't support that, right? So you kind of grow out of it and you grow forward, and you have to find those brokers that specialize in certain things. And to give you an example of that, right, where you got technology and a broker, I had a guy, a gentleman stop by the booth the other day or yesterday, and he was talking about he was trying to short stock in the system. Sure enough, that system only had an easy to borrow list. And so the very next day he couldn't short stock, right? So, but if he was with a system and a broker that had that capability, he could have been doing that going forward. And so that's something that we strive in. That's just an example, but I can definitely see how people just grow in their journey and they need to advance in other platforms and areas.
Yeah, please jump in.
Yeah, I'd like to build on that a little bit. I think, so I've encountered a lot of folks in the space that have tried to build like an omni platform, whether through integrating with other tools that exist out there, which I think is a fascinating, probably the easiest approach. But I think the reality is I don't think any business is poised to make a platform or a product or a research tool that's going to match the constantly changing landscape of traders and how they get an edge. Every market cycle, every year, even every month, there's a new popular edge. So we can look at the rise of dark pool data becoming available on certain platforms, the increasing understanding of how to use options chain data to make informed trading decisions. I think that's only going to diversify. The market is going to constantly be going through cycles. People are constantly going to be trying to find an edge. I don't think there's one platform or business that is equipped to provide that for everyone. So what I see is probably a landscape of products that are for niches of styles of trading that provide those edges. And I've seen platforms try to pull them together, small companies, and some have done some really fascinating things, but not yet. If anyone does, I think it will be a brokerage though.
That's a cue for me.
Yeah, jump in, please.
So I was gonna say, MooMoo, we do believe that from a 80-20 rule perspective, we do meet the needs of at least 80%, roughly, don't quote me, 80% of the traders who are actively seeking better trading tools and data. So we actually provided, this is thanks to our mothership, our parent company has been around for 10 years. So throughout the company, we've accumulated a lot of tools and features that we all have pumped into MooMoo, where if you are a technical trader, you see really, again, at least sufficiently all of the common technical indicators, 60 of them. You know, there are hundreds of technical indicators, but we all know you don't trade on all of them at all times. So we meet majority of the needs with the 60 plus technical indicators and all kinds of charting tools. But if you would rather want to do a deeper value investing, you know, the fundamental analysis, we got those as well. So for MooMoo, especially with regards to sort of the majority of the retail traders, we actually do consider we are meeting them of majority of their daily needs. But just as sort of, I like to think of us almost like Costco. We guarantee what we bring to you has been tested and it's good, but we may not be the Whole Foods. And there's always going to be the Whole Foods out there that will serve two of those points, that they will serve the niche needs in a better way. So ultimately, we believe platforms can all play well together, but we also collectively can help our traders to make informed decisions. In that role, MooMoo's goal is let's provide you the one-stop shop so that it meets majority of your needs.
I love that analogy for Costco and Whole Foods, partially because I live in London, United Kingdom, and I'm from North America. And they have Whole Foods. Unfortunately, I miss out on Costco there, but that's more a personal bias thing. But
bring MooMoo with you.
Yeah, well, you should come. Yeah, I mean that's a pitch. Come to the United Kingdom. We'll bring Costco and MooMoo. That I think, yeah, it's a fair argument that the 80-20, right? There's a baseline of just being able to, you know, have a strategy, to be able to have the tools at your fingertips, to be able to get access to financial markets, and you know, do that. And then I guess, like you're saying, 20%. So if you want to go further for specific tools, you can definitely dip into that. And that segues well into sort of the topic that I'd love to talk around, which is like, what are, like, technology enables a lot of innovation. And part of that's, I'll call this like leveling the playing field, where I have friends that, you know, might work in institutional investing for hedge funds or for banks, and they have access to some amazing tools. And they've had it for a while, and the constant pace and R&D in that has been quite high. But the great thing with technology and fintech and innovation is sort of the barrier to entry to developing and innovating is dropping very quick. And so that next stage of new tools coming out, rolling out, has really been an incredible pace the last couple of years. And so I just love, I think I'd love to hear from each of you around what, like, you work really closely with your customers or users, and, you know, they give you great feedback around what really makes their research process, gives them that edge, that efficiency to really make good decisions. What are some things that really here, you know, I guess what's kind of the next thing, or what are some things that have really become very popular, and, you know, sort of the 20% of let's look at more niche areas and very sophisticated tools that are helping people trade. Neal, is it all right if I kind of call you out on that one?
It's fine.
Your view on that?
Yeah. Well, unusual options activity has been massive. I mean, look at what Unusual Whales has been able to do. People are just using tweets from that platform to make good trades. That's a fantastic edge, and it's a data set that's being distributed. I mean, that can live on any brokerage. It lives on Benzinga Pro. And it's you know, some of these kind of seem like the soup du jour, if you will. So unusual options activity is very, very popular for now. But as I mentioned before, as market cycles change, more things will come up. I don't think anyone has really explained well to retail traders, in a broad sense, how to use dark pool data to successfully trade. There are plenty of products, but they sort of live in that 20% bucket. But I do see that sort of coming forward and being understood at large by retail traders and being used by newer traders, the majority of retail traders, for that edge.
Ryan, like, I think when we were chatting before, you said a lot of customers that really love and use Cobra shorting, and that strategy is really kind of one thing that they come to Cobra because you've got tools around that. Like, what, I guess, when you thought about how do you develop your platform and create tools that really help them with that, what are the things that come to mind really that matter most for them that I guess would be unique to kind of Cobra or just unique to that sort of strategy?
I mean, as far as the as far as like the shorting goes, right? Like the platforms that we offer, you know, have the shorting tools built into them, right? That allow the traders to basically, you know, look the stuff up and research it electronically, right? Beyond an easy to borrow list. And so, you know, where at other brokers, you can't necessarily, you know, short the things. You can come there and you can basically shop on your own, right? And if you like what you see, you can select it. If there's nothing there, there's also a service beyond that. You talked about leveling the playing field earlier, right? Like it's not even just about that short locate tool, but even beyond that, the service behind it, there's even services behind that, you know, your brokers can offer you. And I'm sure, you know, MooMoo and team can speak to that as well, right? Because I think that's one of the advantages these days, right? That with some of these specialized brokers, they can offer you additional services that some of the bigger brokers don't necessarily offer, right? It's more of a white glove service. I like to think of it like, you know, prime brokerage for a hedge fund, right? Or institutional client. They pretty much offer them anything and everything. And I think that's what our goal is as well. So that's another tool that really helps them get to that next level.
And Carolyn, I loved your argument on the 80-20, but when, like, I'm sure, do you ever get tempted to really like, what are the 20-21 and what are some tools that really stand out? Is there any kind of, I guess, things that you always think about? What if we could add this? Like, that would really help people, or like, does anything like that ever come to mind when you're thinking about how you develop the platform?
Yeah, absolutely. Actually, thanks to its long-lasting, you know, business history, MooMoo actually has been beloved by the users in terms of directly mentioning our product managers and our co-founders within the Moo community. You can mention Leif Lee, he is our co-founder, and you can tell him exactly what you want. And oftentimes, and folks are pretty direct. They will say, Leif, I don't like this. And he dutifully, he will take a screenshot, he will bring it back to our work chat, and he will mention the product manager. So the speed of innovation at MooMoo is mind-boggling. Despite that I came from, as I mentioned, I work at Facebook before, I was still shocked with how fast that FUTU, which is our parent company, and MooMoo can dedicate to the product development cycle. So one of the things, you know, we have a lot, but I will just mention one thing. From our technology stack, one of the things we have done is we actually make big data very accessible, very digestible for all the MooMoo users through a lot of the AI features. Few things that we have enabled using AI. One of them is that AI monitor, anything unusual that you as a trader have defined and say, I'm monitoring this particular option or stock, and if the price changes by this percentage, alert me on my phone. And that actually gives traders the physical freedom to at least take a bathroom break, which is really awesome. I mean, obviously, walk your dog if you need to. So AI Monitor has been one of the really popular features. The other one that I thought was really incredibly fun and I can relate to is what we call similar charts. You know, we all are doing, ultimately what we're doing is we're predicting where the price is going to go, right? So we're saying it's going to, you know, based on the past history, based on the patterns, based on blah, 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 all the input, we think the price will go up or lower. What if the machine can ingest all that data? Ultimately, that's what AI is machine learning based on past patterns. What if you have AI that tells me what the price is going? That's what our similar charts is. And it does not discriminate. It tells you with any stock ticker you can find on MooMoo, will give you an AI-powered price prediction. So that I thought was really incredible. Are we super, super sophisticated yet? We humbly believe we could do better, but I have not seen other brokerage out there to provide AI-powered capabilities like this.
You all touched on a really good point. Carolyn, I think you spoke to it very directly, just around, I think you said almost like the pace of innovation is incredibly fast from your founder. I think that sounds like a very interesting journey of just him walking in and being like, you have to do this. I can imagine that. Yeah, it definitely gets attention, but I think you each touched on it, which is markets evolve and move really quickly. And so you're offering, and the amazing thing about technology is you get to market really quickly, like you were talking about, you know, options and dark pools. And, you know, Ryan, you were talking about, you know, customer service and, you know, really focusing around the customer journey around trading, or shorting, sorry. And all those require you to be constantly listening to customers and really rolling out, you know, new features and technology. And I think, is that something, I'll just put it as a question really around, it's not just the type of new features and technology and tools, but do you find the pace of innovation is really accelerated and the level of feedback that in that journey? And do you think that that's really been a big change in how your platforms are developing, and really the pace of change, and how that complements, I guess, markets and how they're developing. Do you ever think that in that way as well?
Yeah, man.
Yeah.
Like, so many people are coming into the market and they're finding traders need an edge that works for them, and they want to stick to that.
Yeah.
They're going to use that one thing. They saw a YouTube video that got them into trading, and it says just use this moving average, or just use this unique data set that can only be found in this brokerage or be found on some subscription platform or something like that. There's always something new. And it's how markets work. I mean, sometimes VWAP is like the only thing people care about. And then other times the only thing people care about is RSI or something like that. So having the customer's voice, as Carolyn said, going directly to product managers. I don't think there's any other industry where people are listening so directly to the community and have such a vocal and specific customer voice. We want exactly this. We want ADR. We want to be able to look at implied volatility, all this sort of stuff, and connect it to these other data sets to create a unique insight. So yeah, I mean, it's just always changing. The ability to bring that customer voice, and again, harnessing this phenomenon of communities forming, of social media, and then having platforms facilitate those communities. It creates a really good feedback loop between the customer and product building. And I think everyone on the stage right now is doing a pretty good job of. It's hard to keep up with from a development perspective, but we're listening.
Yeah, you're so right. Like it's amazing. I guess you're right. Feedback just around markets are very dynamic, and people. I guess there's probably no other area where people really spend as much time, invested around their own, I guess, success. You each touched on it, which is from a lot of people learning how to trade, people kind of coming along the journey of becoming, I guess, better traders, to people who are, do this full time, like they're professional traders. And with that, I guess at each part of the iteration along that journey is learning. And I'd like just to kind of pose a question to the three of you around how you thought about, as you offer digital platform trading experience to your users, how do you think about, do you bring education into that experience, or do you just expect people really just to come in and they already got the tools that they need? What sort of thoughts have you had around that with feedback from your users, but also where you think you're taking your own product? Carolyn, I'll turn to you maybe to kick that off, because I'm really curious to hear about how MooMoo thinks about this.
Yeah, absolutely. Thank you. For MooMoo, what we have found and believe in is everybody's learning journey starts at different points. Some may have been trading since they're 13. Some may have been trading, later in life. So we want to make sure education is accessible to all in whichever, whoever's pace, wherever. And to that end, we have developed a ton of content. The other thing we did also notice is the topic of trading. There isn't a sort of a easy to find master curriculum, unless obviously you come to Benzinga. They have curated a good list of content. We're good friends, we're partners. But at the same time, if you are just a retail trader, you just are starting out, you could stumble upon a video here and there. It's very fragmented. So we also believe in just a educator duty that we provide well thought through holistic curriculum to our clients. The third one is we want to make sure the content that we provide is fully vetted. We're a SEC regulated broker dealer. So all the things that we ever were to produce to our clients, our lawyers have seen. We are very confident that they are not in any way misleading. We're not in a business to kind of do clickbait. So when we push this content, these are the three things we think about, which is you can consume at your own pace, whenever you want. You also have a holistic idea of what it is that you may not even know, but we should let you know so that this content is holistic. The third one is the educational content that we produce is as objective and as tested as possible. And that is, by the way, also, we always do this insight voting. We have these surveys asking our clients. The in-app education has been always voted really high. The last one, just real quick, the last one we also believe is Learning comes in many forms. Some of you guys may have young kids at home, you know. Some kids are more visual learners, some are more, just audio learners. So for the same topic, we are dedicating more resources to create various forms of education. It could be in the form of a text, long form article, it could be webinar, it could be video. We're always listening and trying to produce more to help traders out.
Yeah, I think a lot of the points, well, almost all the points you say definitely resonate. Neal, I'd love to hear from you because at Benzinga, I think it's one of the core things that you really offer people. And I know that you've been really involved in helping develop that proposition and listening to people, your users. And what's your sort of sense of things of how you think about developing, I guess, and working with traders to make them, more efficient, know what to do, bring them on that journey, and how's that really? Have you brought that home at Benzinga?
Yeah, I think the way we did this, we did a lot of research before we launched our trading school, and what we found was that the entry points to learning how to trade or invest are very fragmented. There are a bunch of books. There's so many books that have like similar titles on Amazon and YouTube channels that have just phony traders, that are, not really giving you any information. So people don't have a starting point. So what we wanted to do was launch, and also people don't have a starting point, and there's tremendous hunger to become proficient quickly. People want to make money in the markets, and they're going after it with the same vigor of someone that really wants to go to university to become a doctor or something like that. So the way that we approached it was starting with just the foundations. This is how markets work. These are levels on a chart. These are the fundamentals, just 5 or 6 fundamentals that matter when you're doing fundamental analysis of a company. The absolute foundations need to be instilled first to orient people. And then what happens after that is that people tend to go off in different directions where they find their edge, their thing that works for them, because people have different lifestyles, people have different budgetary requirements, restrictions, and so forth. And so forth. But one thing that I think we did really well that is pretty different is we based it on online education. Plenty of people at Benzinga have finished their degrees online. I finished my master's online, and we based the platform on an online learning management system. So it's live streamed, college course style every day with a chat, with homework, with quizzes. And so it's fast paced, and there are people that enjoy that rigor. And I think as with anything that is going to become your job, if you're going to trade for a living, you got to go through a lot of rigor before you're proficient with it. So that's why I see being most successful.
Yeah, I guess, offering kind of, from beginner to advanced, really, if you want to make money, and you want to make this a serious thing, you can help people on that journey 100% there. Ryan, I'd love to hear your point of view and just how Cobra's thinking about this.
I mean, I love the fact that you guys, make a big effort to educate people because, it's in our best interest, right? As a broker, we want our traders to succeed and we want to set them up for success. And part of that is knowing what you're getting into and the risk involved. And I don't think the awareness out there is enough, right? I think we do need to take that more seriously. And, we try to encourage that with our traders. We do the same thing that you do. We're broker dealers, so we provide a lot of content that's informative and factual. And we have videos, we have blogs, we do all those things that most broker dealers do. I would say on top of that, we also have all of our support guys and the guys that answer phones and chats. They're all licensed brokers. They've all traded. So, they're familiar with it, they're familiar with the platforms, and we try to help in that aspect as well. But the other thing that we do see from our longer term, more successful traders is that they're part of trading groups, right? They have a trading family. And it may be an investment club, maybe a Benzinga, maybe just 5 guys sitting in a garage trading together, right? But, I think that helps a lot as far as learning together and growing together instead of, doing it on your own.
Yeah, that's an excellent point. And I think, yeah, you learn on your own, but you also learn together. And I think one of the trends that like I observed that I think is no surprise to anyone is just around social and how that's become unbelievably like intertwined with the trading experience. And I'd love to hear from the three of you really around like how have you thought about, I guess, the platform experiences you're offering users, and how do you bring social into that, or does social sort of just always operate around it? Neal, maybe I'll kick off with you. That's fine, just to talk a bit about that.
Yeah, I think we might be going into contrarian territory with this one.
Oh, fire away.
The Twitter space, we're at FinTwit. Financial Twitter it's a whole conversation, and there are plenty of people that use just Twitter as their information source. But a lot of times, that information is slower. That information is subject to groupthink. A lot of folks piling into, as we know, certain phenomenons like meme stocks and so forth. But going back to the point made earlier, groups are absolutely essential. I know that Rob Smith was here previously, and he says, we don't trade alone. It's 3 people minimum that are trading together. And actually, we have an educator at Benzinga who today said that one of the number one things that we do as a group in our chat room trading is we collude. We encourage collusion in trading. And that's how hedge funds, that's how floor traders, or not floor traders, but big money managers, that's how it works. Traders have a phone call every single morning. This is what's happening in the market. Let's try to find some form of consensus, what direction we're going to go in, and we share information when we trade together. And I think that's new for retail folks. I mean, during the .com bubble, you had forums. It's a very slow way of gaining information, getting insights from people that have similar styles to you. But these days, I mean, it's so fast. A chat room, Discord, voice, bringing those things onto platforms, it's a must-have.
Yeah, definitely. Ryan, I think he prompted this whole thing around.
Yeah, well, when we bring on new accounts, right? Like one of the questions we ask is, what's your investment knowledge? Where'd you learn? Where'd you, get your trading experience from? And almost always, they've gotten influence from somewhere. They've taken some online course, they're part of some group or something. And so, that's very telling as far as the social aspect goes, that it's out there and they're learning, they're part of something. I think it's great. Again, we're very careful with the social stuff because we're, a broker-dealer. But, one of the things that we keep getting asked to do as well is integrate with social, platforms. For example, there's platforms that want to take our trade executions for traders and share the trade history so that trader can then share their strategies, with their followers, and people can learn from their wins and their mistakes and so forth. Sorry about that. Those type of things are being asked nonstop, and I think that helps the traders because they're kind of operating. They have their trading world, and then they have their social world. And how do you get that to seamlessly come together, right? And if you can integrate it somehow, I think that would help them tremendously. And the social aspect also helps us as well. There was a guy that stopped by yesterday talking about the trading forum he's in, and they post. The traders, they post their trades, especially their successful ones, right? And so, one was posted the other day where they got a short, and the other guys in the room couldn't get the short elsewhere, right? And so when they asked where they got it, it's Cobra. Well, that's like the best kind of, I guess advertising we can ask for, right? So we love the social aspect. A lot of our clients are very, very socially, aware, and so that's just kind of how it impacts us in our trading.
That's it. Yeah, makes perfect sense. Carolyn, like with MooMoo, I think social is a big kind of anchor point for how you develop your platform from day one. What's that kind of, where did that start, and how's it evolving over time?
Yeah, I want to cue back our founder again. Leif, he was actually trading alone before he founded MooMoo. He was trading his personal amount of money. He ended up hiring like several guys trading for him. But even that, he felt like I was trading like so alone. I had to make all these decisions in isolation. And his background was working in a social media platform before. And so he figured, nobody is doing this in trading. Why don't I start doing this? So basically, MooMoo was sort of having this integral social component at day one or at birth. What we have seen, though, is social really has come to serve our clients in a very positive way, roughly 3 areas. First is our clients, they are able to connect. In this connect, that's sort of the collusion take place very naturally. It's that you can mention anyone, you can follow anyone, you post things, and if you follow them, let's say I follow Ryan, I'll see his new posting every time I log back to MooMoo first. So that gives me an opportunity to really connect, discuss, and have the insight, sort of the word on the street perspective as I think about a stock. The second thing we have made it easy for traders is you can find inspiration. We interview and research with a lot of customers and said, how do you find your stocks? Besides the YouTube, many of them, obviously, they go to social forums and they search for ideas. Again, back to sort of human nature. You don't know what you don't know. So social provides you that opportunity to see the things that other traders have seen that may be at least worth you checking it out. So we make that easy by a built-in function, and we rank sort, we filter everything by the stock ticker. So let's say you're interested in Stitch Fix. You find all the chatters just about that one stock. So that's utility from a utility standpoint. We make that human nature work easy. And the third thing is we believe social is an area where you also can just further sort of understand and provide support to each other. I don't know if you all do this, but I have seen traders like to brag about the wins. I mean, it's the same as video games. If you come to the highest level, you want to brag about it. But in trading, where do you brag about it? That's in a way that's organic and that's not coming off weird. It's best to brag with the other traders. So we actually made this very easy. If you've seen your P&L, for a stock hitting whatever level that you're really proud of, we generate, it's kind of funny, but we generate a little graphic that shows the stock and it shows like how much was your return. You go, yeah, killed it. We just make it kind of fun in that sense.
Yeah, I love that. I love that. Just making it easier for people to do what they're going to do anyways, and getting that message out. Well, generally, this has been a real pleasure. So thank you for joining. I think hopefully this gives, I guess, everyone here a great insight into just different things from a platform point of view of how can the experience for traders be better and where is it going, especially when we think about social, education, learning, different tools that are available, how markets evolve. And it's been a genuine pleasure. So thank you, Carolyn, Neal, and Ryan for joining and sharing your insights and how your companies really see the future. And I generally hope to kind of pick up the conversation at various points going forward. But with that, just please everyone give a generous round of applause for the panelists. Perfect. Thank you.
Thank you guys very much. And with that, that is a wrap on FinTwit 2022. I think actually they're still going over on the other stage. If you want to pop on over there for the last few minutes of that, feel free to do so. But as far as this track, we're done. So thank you all for attending and coming to hang out with us here for the last couple of days. And give yourselves a hand. I mean, so with that, we can just roll for everyone watching on stream. We're going to roll the outro video, and for the rest of you, let's go to the pool. All right.